Recent weeks, that's as access to credit tightened. European and US equity futures point to mostly lower openings. US Speaker Kevin McCarthy proposes a $1.5 trillion increase in the debt ceiling, that as fears grow that falling tax revenues could hasten the date of a potential default. Plus, Tesla slumps 6% post-market as Elon Musk signals deeper price cuts despite the squeeze on margins. And TSMC beats on net income, but forecasts worse than expected second quarter sales on fading demand. Let's take a look at these futures then as we weigh up the picture when it comes to the earnings front. Futures pointing lower by about 0.2% on the DAX. Weighing up a mixed picture, I said, on the earnings front, you've got the likes of Nokia coming through with a miss, Renault, the French car maker, coming in with a beat. And of course, we continue to weigh up what we're seeing in terms of the direction coming through from the likes of Tesla, the margin squeeze, but TSMC as well in terms of semiconductors, the demand softening a little bit, even as margins in the first quarter came in higher than expected. The FTSE 100 currently down 0.2%. We continue, of course, to weigh up the direction for the pound as well. We had a call from Jeremy Stretch, and you get to maybe 126 on the pound in the weeks and months ahead. The Spanish IBEX currently gaining 13 points. The CAC current over in France down 0.1%. Cross asset then, after a bit of a mixed picture, flat essentially for the US close yesterday. Cross asset, you're looking at futures now. NASDAQ futures down 0.4%. That's despite the fact that yields are coming off just around 3 basis points, as you can see at the front end at the 2-year. 421 is what you're seeing on the front end. The context for the NASDAQ is that you've seen a rally year to date of around 19%, but the future's pointing lower by 0.4%. 109 on euro dollar. Again, to quote Jeremy Stretch, his views that euro dollar, you could be getting to 114, 115, so some more upsides to the single currency, partly as a result of views on a softer dollar. When it comes to Brent, $82 a barrel, down 1%. There is a bit of a squeeze on commodities, tying into that recession obsession theme coming through from the Fed's Beige Book. Tighter credit conditions. The Fed's John Williams as well, citing the tightening of credit conditions for businesses, households, though he says more work does need to be done in terms of getting inflation back down to that 2% target. So, the US economy stalling in recent weeks with hiring and inflation slowing. And, as I mentioned, access to that credit starting to narrow. That is according to the Fed's monthly Beige Book survey of regional business context. Let's bring in then Christina Quito, managing editor for Bloomberg Markets. Beijing, in terms of the Beige Book, we can talk about Beijing and the China input maybe at some point, but the Beige Book pointing potentially to a stalling economy in the US. What are the details that came through? Where is the weakness? Are we starting to see cracks in the jobs market, for example?
Yeah, I mean, Tom, I think the main theme really from the Beige Book is those tightening credit conditions, right? And part of that is, of course, a result of more than a year of Fed rate hikes that have been coming through continuously. But then also part of that is the more acute credit stress that we saw from the banking turmoil in March. And so that combined looks like that is starting to flow through to the availability of credit for companies. Now, this is fine. I think this is sort of the softish landing that the Fed wants to engineer. Where this becomes more of a problem is, again, the jobs lever, because if there is more widespread credit unavailability and that becomes more painful and acute, then that could easily spiral into job losses. And we're already seeing layoffs as a theme in the tech sector, for instance. But if this credit crunch becomes more painful and leads to wider layoffs beyond the tech sector or certain sectors, then that is where it becomes more of a, I suppose, a recessionary spiral, which is something that isn't necessarily in the cards for now with regard to the Fed's expectations.
I wonder, though, to what extent that is the bet being played by some traders as you look to those moves pricing in cuts from the Fed by the end of the year. Does it make sense in that forecast scenario if that comes to the fore?
Yeah, I think that is exactly what the traders are looking at when they're betting on rate cuts, is that worst case scenario coming to fruition. It's not the base case for most people in the market at this point. I think it really is still the expectation that the Fed will pause after May rather than start to consider rate cuts. But again, I think this could very easily spiral from, a soft landing where it's just kind of a mild recession, which is what the Fed expects at this point. But then that spiral of a credit crunch leading to mass layoffs could then validate those bets for Fed rate cuts if it does turn into a deeper and more painful recession.
Okay, Christina Kino from our markets team, thank you very much indeed for setting the scene. Let's get more analysis now and bring in Maria Monici, multi-asset fund manager at M&G Investments. Maria, good morning. Thanks for joining us in the studio then. So, Christine, really painting a picture of a US economy that is balancing on the head of a pin. Is that where we're at now then? It's a question in terms of the balance between a soft landing but the ease with which this could fall into a hard landing and the consequences for the Fed.
I think the data points that we received in the last few weeks really paint still quite a balanced picture. So we have seen inflation data that continues to come down, more on the headline data, but if you look at the core, there are still many sticky elements there, which should support higher interest rates for longer in the US. The wage situation is also kind of moderating within the labor market. The excess are kind of coming down. The beige book paints a very, very interesting picture, which is not completely disjointed from what we were already seeing on some of the leading indicators. For example, the ISM manufacturing data already pointing to quite significant softening. I think the key question here is what will be the actual real impact of the banking crisis we've experienced in the last few weeks. Investors have been quite quick to brush it off, and we've seen markets remaining quite resilient during that. But the key question will be
to brush it off, the banking crisis?
Well, we are starting to see some weakening on credit and loaning and lending attitude from those banks. So it remains to be seen how extended this will be. And is it going to be in favor of the policy of the central banks in terms of slowing down the economy, or is it going to go a little bit too far?
The estimates that it's done some of the work for the Fed for it, whether it's 1% or 1.5%, depending, take your pick on which economist or which strategist you're listening to on that front. So where does that leave your views then on the Fed? Do they hike again in May and then pause? Bullard talking about 5.75 potentially for the terminal rate.
I think they also remain very data dependent. So the data that we're observing now is still conducive to elevated rates for longer and potentially a slight increase from where we are now. But it remains to be seen how long will the economy remain resilient for, and how deep is going to be the potential reversal we're going to see. Obviously, one element to point out is that regional banks in particular, which were at the center of the banking crisis, are very impactful for the real economy in the US. We've seen larger banks from the earnings result even more recently remaining very resilient in this environment, and actually in some cases gaining from the dynamics that followed this banking crisis. But it's the regional and smaller banks that might be more impacted going forward and have an impact on real economy.
Yeah, you flagged what you've described as surprising resilience within particularly the larger banks. Where do the earnings leave you in terms of where you want to be positioned in this potential recessionary environment?
Well, I think larger banks have obviously posted some very good results as a whole, with some mixed differences in there. But
do you buy those banks?
I think valuations in many cases is still supportive in the US, but even more so potentially in European markets. And those banks are starting to benefit from higher interest rates environment. Obviously, how the economic growth will develop in the next few months or so will be crucial for them. If you have a very strong downturn, you wouldn't expect those banks to behave well. But in a more mixed environment, you still have supportive valuation on your side to invest in some of those assets.
The Nasdaq up 19% year to date. You're seeing Nasdaq futures under pressure today. Is that a safe haven? Is tech a safe haven potentially?
Well, it's very interesting behavior what we've seen in the tech sector. Last year, obviously, has been the worst performing. strong. We've seen strong discounts and valuations coming down a lot. This year, a very opposite trend in the hope that interest rate cycle is kind of starting to peak. Valuations are more attractive as a whole, and there is potentially more resilience in some of those stocks, not all of them, relatively to a potential downturn on the global economy, with companies still willing to spend on tech. So the behavior of this sector is quite an interesting one and potentially quite a useful one to have in a diversified portfolio.
And you're calling for a regional bias towards European equities. How does that call hold up in the face of expected, at least within amongst some traders, expected 3 potential additional hikes coming through from the ECB? That is still a live debate, but hikes are coming.
Yeah.
How does your thesis on European equities hold up?
Yeah, so I think, overall, on an equity position, we maintain relatively neutral portfolios. But within this neutral position, there are some preferences. And obviously, European equities is part of this preference, in particular due to the current valuations that we observe relatively to other markets, the US being a clear example. But also in the context of interest rates that have been less aggressive in Europe than in other parts of the world, and where, therefore, we might not see the same unexpected accidents as we have seen, for example, in the US in the banking sector, etc. At the same time, I think the policy in Europe will be also determined by, first of all, data, what type of data we're going to see in the coming months, and also what other central banks are going to do in the coming months.
What's your preferred hedge?
So we still like, from the diversification standpoint, treasuries, especially given the level of yield that they are trading at now. Obviously, it's an area that has seen a lot of volatility in the last few months, but nonetheless, in a situation of extreme risk-off, we still believe that some of those assets will be able to deliver diversification in a multi-asset portfolio. Okay. This, together with liquidity and cash, still
Maria,
represents.
fantastic. Thank you very much indeed. Maria Monici, multi-asset fund manager at M&G Investments, neutral on equities, a bit of a bias towards European stocks, maybe still some upside for tech. The banks looking interesting, particularly in Europe, and maybe diversify in terms of risk off to the long end of the US curve. Coming up, not looking chipper. Thank you, producers. TSMC's revenue outlook disappoints as the global tech slump continues. We'll get the latest next. This is Bloomberg.
Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
DOJ or other authorities could face bigger
bigger challenge.
Britain's next
was going to keep rate World Cup. This is a 3.
as the economic picture does.
The UK is getting ready to make a decision.
Welcome back to the Open. 30 minutes into your European trading day. Losses of 0.1% across the European benchmark. Futures in the US also pointing lower, between 0.3 and 0.5%. That on the Nasdaq futures. Across your sectors, top of the list, banks gaining a full 1%. At the bottom, autos taking a big hit, down 2% as things stand. Basic resources also as a sector under pressure as you look at iron ore, copper and Brent also feeling the squeeze. Across the bond markets, bonds are bid, yields are down across the US Treasury curve. Let's get to your stocks to watch, though, this morning and bring in from our equities team, Joe Easton. Joe, good morning. What are you looking at?
That's right, Tom. So Renault is leading those auto stocks down, as you mentioned just now. That stock dropping almost 7% over in Paris as the company warns that it'll potentially need to cut some pricing of its electric vehicles, and that is dampening sentiment around better than expected quarterly sales of its SUV model. Meanwhile, Nokia also jumping, saying pretty much the same thing as Ericsson earlier in the week, that a lot of 5G companies are cutting back on infrastructure spending, hitting their order books for bid projects, that one dropping in Helsinki. Meanwhile, L'Oreal giving us some green on the screen here, up around 1%, doing really well in active skincare, so this is skin creams and that kind of thing, doing really well there. 30% sales increase, more than double analyst expectations. That one up 1% in Paris. Meanwhile, Deliveroo here in London dropping 1.5%. One of the worst performing IPOs we've had in London over the past few years. Now seeing a continued slide in sales. Orders were down 9% in the latest quarter. They say customers are cutting back due to the cost of living crisis. That's hitting that one here in London today.
They are not delivering. Boom. Joe Easton, thank you very much indeed. With your stocks on the move, looking at autos, the healthcare space, or at least the skin product space, and your delivery company as well. Now, to all things semiconductors. TSMC's profit beaten expectations after its chip margins held up better than anticipated. The March quarter earnings come as Taiwan's largest company and the biggest maker of semiconductors globally grapples with persistently weak electronics demand as consumers and corporations tighten their budgets. Joining us now is Bloomberg opinion columnist Tim Culpen in Taipei. Tim, what for you then were the key takeaways from TSMC's results?
I tell you what, it's been a really whiplashy 90 minutes for TSMC in terms of putting out their numbers and then giving us guidance. So top line did really well, it beat estimates. The bottom line was beating estimates. The top line was in line, so they managed to squeeze out extra profit through cost controls. But then they gave the outlook. They said that this year, their revenue and the industry revenue will be worse than expected. In fact, TSMC sees the first half of this year dropping 10%, rebounding in the second half and actually seeing a decline in revenue for the full year. That would be the first time, by my calculations, the first time since 2009, so the financial crisis, that they had a year-on-year fall in revenue. What's interesting, the big surprise, is they did not cut their capex. Now, there's a lot of rumor and debate over the last week that they may cut their massive capex budget, 32 to 36 billion US dollars. They didn't. They're sticking with it. They are not flinching. The reason is that they still believe they're going to need that kind of capacity over the next few years. And more importantly, ChatGPT and all this excitement about AI is driving a lot of demand. The chips that they make at the leading edge are very, very important to the AI space, crunching all those numbers. And so they're really plowing ahead to make sure there is enough capacity, especially in the second half of this year, to ensure that enough chips will be coming off their factories that can go to NVIDIA and AMD and Intel and all the other companies that are moving into the AI space.
The potential AI catalyst then for TSMC and some of its rivals. How do these numbers and how does the commentary then, Tim, feed into your views, your assessment of the health of the broader chip market?
Well, clearly the broader chip market is looking weak. It's looking weaker than we saw 3 months ago. One of the key things that TSMC did point out is the reason why they're cutting their outlook for the year is that the inventory digestion that they had expected in the last 3 months is just not happening at the pace they expected. It's slower than they expected. They pointed specifically to China. The opening up of China after the COVID pandemic is not bringing on the demand that they'd expected. That opening up is much slower than they anticipated. So a lot of the stockpiles that they had seen sitting on the shelves of themselves and their clients is just not going down. In fact, it's rising, which is a surprise to everybody, including TSMC. And so that's been a real problem. It means that for the overall kind of chip market and the electronics market this year, it does look weak. It looks weaker than we expected, but there is that shiny spot, which is AI, which is not really end consumer market. It's really sitting in servers, churning out cute poetry through ChatGPT.
Yeah, cute poetry and a little bit more. We'll see if that has an impact on those stockpiles then going forward. Tim Copeland, excellent. Thank you from Bloomberg Opinion on those results from TSMC and the broader implications for the semiconductor market. He pointed out that CapEx, and that they're going to stick to their guidance on CapEx, TSMC, of between 32 and 36 billion, which surprised some. That is good news, of course, for the likes of ASML, which makes that very high-tech kit that TSMC relies on to produce and churn out all of those chips. That company then gaining 1.3% after the losses of yesterday. It took a hit yesterday, the stock, on disappointing guidance around demand, but the CapEx call from TSMC, sticking to that, giving a little bit of upside to that stock this morning. ASML gaining 1.4%. Let's get the Bloomberg Business Flash now with Sam Etienne. Sam.
Morning, Tom. Elon Musk has signaled that Tesla is not done cutting prices after the company missed first quarter profit estimates. Shares in the EV car maker dropped in after-hour trading as the CEO argued there are good reasons for more price reductions. The base price of the Model 3 has now dipped below $40,000 in the US for the first time in years. And L'Oreal sales have jumped more than expected, with the French cosmetics giant reporting strong demand across most regions and business divisions. Like-for-like sales in the first quarter were up 13%, well ahead of forecasts for a gain of 8%. North Asia, which includes China, was a weak spot, however, with the company reporting supply constraints. And one of China's best-performing hedge funds has sold its property bonds, joining several peers in unwinding bets on the nation's economic recovery. Purchases of the beaten-up assets helped spur, get this, a 523% increase in Shanghai Bull Asset Management's distressed debt strategy last year. The fund now says it's concerned about the property sector's debt burden. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg. Tom.
Sam, here in London, thank you. Now, coming up, HSBC pushes back pretty firmly against a proposal to spin off its Asia business. We'll have more on the lender's continuing battle, stepping up a gear with its top shareholder. That is next. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Welcome back to the Open. We are 23 minutes into the European trading day. Losses across the European benchmark of 0.2%. Of course, investors weighing up the earnings picture and what we have been seeing in terms of the Fed Beige Book and what it tells us about a stalled US economy. Tying into what we're seeing in the commodity space, real pressure coming through for the likes of iron ore, but also Brent and WTI, a third day out of 4 where you've seen oil down. You're back to $81 a barrel on Brent, down 1.5% in the session today. Again, tying in to those concerns about the recession that could be emerging in the United States. Let's get back to the earnings story, though, and particularly the banks. That is a sector that's gaining today, a little over 1% here in Europe on the sector basis. Morgan Stanley's investment bank, though, and wealth management unit beat first quarter expectations. That's even as profits fell from a year ago. Let's bring in Bloomberg's Charlie Wells with the details. What went right? And what was amiss then for Morgan Stanley?
Well, wealth certainly went right at Morgan Stanley. When you look at that wealth unit, their revenue was up 11% from the year before. Their CFO said that after all of the turmoil that we saw in the banking sector in March, $20 billion went into that unit, which is really good news for them. And also now you see the wealth unit overseeing $4.6 trillion. So think about all the fees. Wow. That is going to cause a lot of jealousy across Wall Street. But on the downside, look, equities trading was actually a miss. That was a big part of Morgan Stanley's strategy. That's going to be disappointing. Also, you saw loan loss provisions quadruple, so potentially some thoughts about negativity on the ability of customers to repay loans in the future.
So that crown has switched, hasn't it, between Goldman Sachs and Morgan Stanley a few times. It's back with Goldman Sachs, at least for now, on the equities front. When it comes to the regional lenders, though, Charlie, where is the focus? What are we expecting?
Look, we're really focusing in on deposits. Which of these smaller banks have been able to deposit or have been able to bring back deposits? So that was really a part of the crisis in March, where there was concerns that a lot of these regional banks could lose out on some of those deposits. But even banks that do say they've been able to stabilize have been saying that they need to pay more in order to keep their customers with them. And also, we had this week Apple and Goldman releasing that savings product offering 4.15%, which is going to put pressure not just on the small regional banks, but on the bigger ones as well.
We've talked about this dispute. We'll switch focus now to what's happening in Asia, particularly HSBC and its operations there and its largest shareholder. This has been an argument that's been rumbling for at least 12 months, but it seems to really have stepped up a gear.
Yeah, maybe moving from a rumble to a growl. So
yes.
Ping An, which is the largest shareholder in HSBC, has effectively been calling for HSBC to spin off its lucrative Asia unit and to list in Hong Kong. They say that this could help with performance, it could help with market competitiveness. Now, HSBC says that that could actually destroy shareholder value. It could take a hit on dividends. And this actually has kind of been out in the open for about the past year or so, I would say, but this seems to be heating up ahead of first quarter earnings reports on May 2nd, as well as an annual shareholder meeting. But it's getting fairly heated. One executive at Ping An saying that HSBC was being close-minded, and so some harsh words there. We'll see how that pans out.
Yeah, it seems like the gloves are coming off in that battle between Ping An and HSBC. Charlie Wells, always excellent. Thank you very much indeed. Coming up, we're going to be joined by the CEO of Nibulon. That is one of Ukraine's biggest grain producers and exporters. Really important for that economy, but for the global commodity story as well. Stay with us. This is Bloomberg.
ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool featured spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family? I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. The Fed's Beige Book suggests the US economy stalled in recent weeks as access to credit tightened. US Speaker Kevin McCarthy proposes a $1.5 trillion increase in the debt ceiling as fears grow that falling tax revenues could hasten the date of a potential default. Plus, Tesla slumps post-market as Elon Musk signals deeper price cuts despite the squeeze on margins. And TSMC beats on net income but forecasts worse than expected second quarter sales on fading demand. Let's check in on these markets as the earnings picture fails to reassure. You are risk off across these markets today as investors weigh up the picture from the Beige Book, the commentary from the Fed's Williams on those tighter credit conditions. Currently, across the European benchmark, down 0.3%. And of course, the earnings picture is feeding into everything. You see that reflected in autos with the disappointment around Renault. It was a beat, but investors are selling off that stock, at least for now. The DAX is down 0.6%. Here in the UK, FTSE 100 trading just below that 7,900 level, down 0.1%, losing 9 points so far in the session. Let's switch it over and see how things are shaping out then across the sectors. Banks are holding up. That's despite the fact that yields are coming off across the Treasury curve. There is a bid for bonds for the moment, but you're still comfortably above that 4% level, close to 4.2% at the front end. So that support remains for the banking system, at least for now, in terms of net interest margins. Currently up 0.8%. Morgan Stanley was a beat. Of course, the equities part disappointed, but fixed income as well was part of the mix there for Morgan Stanley. They handed that equities crown back to Goldman Sachs. Insurance gaining 0.5%, real estate down 0.2. At the bottom of the list, I should say gaining, real estate gaining 0.2%. Bottom of the list, I mentioned this, autos and parts currently off by 2%. Renault is part of the mix there. Basic resources, commodities, iron ore, copper and Brent all under pressure. And again, you can link that to those concerns, those mounting concerns about a recession in the US. The last time I checked, Brent was trading at about $81 a barrel. Let's stay in the commodities space, though, and switch to soft commodities and the impact of Russia's war in Ukraine. Ukraine's Black Sea crop shipments resumed yesterday following another brief halt which sparked fresh uncertainty about the agreement. The deal has been crucial for bringing down global food commodity costs from records that were reached, of course, after Russia's invasion. Kyiv blames the stoppages on Moscow, which has been accused of stealing Ukrainian grain en masse since the outbreak of the war. For more on this and much more, I'm very pleased to say we are joined now by Andrei Vadatosky from Kyiv. He is the CEO of Nibelon. It is one of Ukraine's biggest grain producers and exporters. So crucial for the economy of Ukraine, but also when you think about commodity prices globally and food supply, Nibelung really sits at the heart of that. Sir, thank you for joining us this morning. Let's start here then. How have you and how has your company adjusted to Russia's conflict on the ground in Ukraine?
Well, thank you very much for your interest. And actually, the problem what we have is to explain that there is a business in Ukraine, that we are still working, and people receive the salaries, and we are still surviving, because basically everybody is concentrating on the macro help, on the military help, but there is no financial help. So our company is located on the south of Ukraine, where basically we have invested enough money, more than $2 billion actually for the last 20 years to develop the infrastructure, port facility, river navigation, simply to make Ukrainian grain very competitive. And as a result, Ukraine has become the exporter number 3 or 4, depending on the commodities. And with the war, actually the whole navigation on the Dnieper River and Nikolaev port was closed, and still blocked vessels, seagoing vessels in Nikolaev. More than 100 ships are still blocked, and nobody is explaining the reason. And secondly, we are very grateful to United Nations initiative, because with this initiative, Ukraine could export 20 million tons of grain so far from 22nd of July. We are grateful for European community who was trying to set up solidarity lines on the Danube River. So we are again investing into new logistical chains, simply finding the way for Ukrainian farmers to receive the income, to start seeding again, because basically the world needs more food. And actually, with a higher logistical cost, actually the profitability for the farmers are lower, and we already see the results. You know, because today everybody is concentrating how to get the Ukrainian grain out of the country, but nobody is thinking what to do next year. Sure.
The importance of the logistics, the importance of developing that sector for the people of Ukraine and for the globe as well, in terms of those commodity prices, absolutely, of course, in focus for us. Can you just give us an update in terms of that, in terms of that Black Sea initiative, that corridor that has been reopened? What is the status of that now, and what is your confidence that is going to be held up and sustained in the months ahead?
It depends what you call reopen, because basically today is reopened, tomorrow is reclosed. Yeah. So and it's actually the tool to manipulate and actually to control the export and GDP and the economy, because the war is not only on the military side, it's in the newspapers, it's a propaganda, it's as well as on the economic ground. And actually blocking the ports, you really fight with the economy and fight against the business in Ukraine. And that is why, you know, if Russia is breaching the law, breaking the borders, of course, they are not going to respect what is called the grain initiative. And that is why they are simply using every day with the inspections for the vessels to come in to the Black Sea and get out, you know, simply to manipulate the prices on the wheat, on the corn, and actually on the food, because basically what they are trying to do, they're trying to create the problem for the farmers so that they are going to into the bankruptcy. We already see that wheat has been seeded less by 40%, and we will have less export already next year. And what to do with
you talked about that investment of around $2 billion in ports and infrastructure. I know that, of course, has consequences in terms of the debt that you and the company have had to take on. About $570 million is our understanding in terms of the debt that Nibelung owes to about 26 banks. And I know you've talked about the need for financial aid. We're looking at one bank, for example, MTB. It's asked for some of those funds back. What is the status of your conversations with those lenders in terms of financing?
Actually, already more than 1 year, we are trying to achieve what is called a standstill, because basically the problem is how to predict the future during the war. And that is why what we are asking is simply to have a standstill agreement that nobody is taking the action against the company, because it's not our fault that all our some part of our facilities were destroyed, that grain was harvested from our fields, some grains were stolen, and the company is not operating fully. So it's everything is clear, is on the table, and that is why what we were asking is simply to have the assistance from the Ukrainian state banks, from the private banks, from the international financial institutions, and actually we need this help today. And we are not simply
need that help
asking
today.
much.
Is MTB alone, or are there other banks that are calling in their loans?
For the moment, it is alone, and that's the only bank that was forced, in my belief, to take those actions, because and personally I understand them, because our business has lost and their business is losing, and that is why we need some kind of regulation, international funds available to solve those issues, to avoid actually the fight between the different economic, let's say, institutions, the company fighting with the banks and banks fighting with the companies, so that is why we need to have this kind of intermediary solution, because we should survive during this period of time, not to fight inside of Ukraine, not to destroy the economy further, and that's basically in the interest of Russia.
We've seen a number of Eastern European countries, I'm thinking Poland, Hungary, Slovakia as well, banning, at least temporarily some of them, the import of Ukrainian grain. Talk to us about your reaction to that and what you think that does, the outlook for demand, the outlook for grain from Ukraine in the months ahead as we lead towards the end of the year.
Well, it's my belief it's a highly political issue, and somebody is playing on this ground, unfortunately. Trying to get the benefits, some maybe compensation from the Brussels. I don't know the actual reaction, but again, so we had the highest prices ever at the beginning of the war, so half a year ago, 1 year ago, and the farmers in the eastern part of European Union had plenty of opportunities simply to cash in the money and to put extra profit into the bank accounts, but they have not done this. And that is why they are trying to put the blame on Ukrainian grain. So think about that. If, for example, the ports were unblocked and Ukraine could export as much as possible, then the prices what you're showing right now, they wouldn't been so high. And that is why we would not see this opportunity. So it's basically, I think, a lost opportunity what creates this kind of a political mess on the neighboring countries. But I think European Union will intervene and will be able to solve this issue very quickly.
Okay. Andrei Vadatursky, really appreciate your time. Greatly appreciated. Nibelung, Chief Executive, of course, a company that sits at the heart of global commodities and, of course, essential to the economy of Ukraine, how they are navigating that conflict, that war, and the necessity for further financing and aid. Now, coming up, pumping the brakes, aggressive discounts eat into Tesla's margins, but CEO Elon Musk says he isn't worried. We're going to break down the numbers for you. That is next. This is Bloomberg.
Okay, so you're moving in on me quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Welcome back to the Open. We are 45 minutes into the European trading day. You are risk off across these markets, down 0.4% across European equities. Futures also lower, markedly lower now in the US. S&P E-mini is down 0.7%. Nasdaq futures down 0.9%. Bonds are bid. Commodities under pressure. Across your sectors here in Europe, just three holding up: banks, insurance, real estate. Everything else is underwater. Autos leading the losses, down 3% on autos. Renault is part of the play there, but also, of course, weighing up what's come through from Tesla. Continuing, it has pledged to cut its car prices to boost demand at the expense, of course, of those profit margins. The sizable price drops are already eating into the automaker's income. Tesla's operating margin was 11.4% in the first quarter, down from 19% a year ago. For more, let's bring in Craig Trudell, our global car editor. Craig, what stood out to you then from these earnings? It's the stomach of Elon Musk to take further pressure on margins. For me, that was a standout. What else was there in the mix?
I think that's absolutely right. I sort of went into these earnings expecting that because on the eve of them, they were cutting prices yet again. Surely Musk would come out and say, okay, we're done for a while now. He did not do that. Not only that, he gave some pretty strong signals that there's more to come here. And I think when you sort of take a step back and look at these earnings a little bit more closely, the German plant that they opened last year was at the very end of March. So effectively, they didn't have any production out of that factory. They then opened the plant in Texas. So we're talking about 2 additional car plants than they had a year ago, and yet automotive revenue only up 18%. That to me is a sort of big cause for concern. Musk and Zach Kirkhorn, the CFO, talking about this idea that they have plenty of room to work with in terms of margin, and that they're comfortable with what they're doing. But I think it's hard to sort of stomach that if you're an investor, to look at the challenges that they're having on the top line.
Yeah, they're very keen to point out, aren't they, the margin difference versus Ford at 4%, GM at 6.6% versus their 11+% still for margins despite those price cuts. Look, he's known, of course, Musk, for making pretty bold predictions. Did he come out with more in the call? Anything in terms of his tone that stood out to you?
I think one of the things that was a little bit new was this idea that on the front end, they're willing to accept limited profitability or limited margins. And this sort of idea that on the back end, maybe they'll be able to make sort of recurring revenue or revenue related to software services. I think this idea that they're going to be able to sort of deliver autonomy is something that they've talked about year after year as being a sort of hope and a possibility. I think there's a lot of skepticism, in part by the fact that it's year after year and we don't see that. And I think while there was yet another sort of half-hearted attempt to say we'll get to full autonomy this year, I do think it was really marked just how many times we heard Musk talk about, I don't have a crystal ball, and talking about sort of economic uncertainty and stormy weather, referring to the economy. So it was unusual for him to be sort of downbeat. He's often, kind of accentuating the positive on these calls.
Okay, a conservative, a cautious Elon Musk on the call. Craig Trudell, thank you very much indeed. Of course, our global car czar, breaking down the earnings picture from Tesla. Let's switch focus now to US politics. Speaker Kevin McCarthy has proposed a bill that would raise the American debt limit for about a year and cut federal spending. Bloomberg's Bruce Einhorn joins us with the details. Bruce, what do we know about this proposal and its likelihood of actually getting through the legislative process in D.C.?
Well, to answer your second question first, there's almost zero chance of this getting through because the Democrats control the Senate. So even if McCarthy were able to get this approved by the House, where the Republicans do have a majority, it wouldn't go anywhere in the Senate. That said, it could potentially be the basis of some sort of negotiation if at some point the two sides really do sit down to start talking. So what Speaker McCarthy has proposed includes $130 billion of cuts, returning to fiscal year 2022 spending, then increase in spending of about 1% for 10 years, other limits on things like programs for the poor, like Medicaid. There would also be an agreement to raise the debt ceiling, and that's something that some Republicans just don't want to do. For his part, President Biden has already said that this is a non-starter. The president says that the Republicans need to come forward with an actual budget proposal because while Kevin McCarthy has said, let's do $130 billion in cuts, they haven't said where those cuts would come. And President Biden has said, once you do that, then we'll have something to talk about.
Yeah, I mean, look, to say that there's a gulf between the two sides when it comes to the debt ceiling is really kind of understating it, isn't it? How much time, Bruce, do we have left? The clock is ticking.
It is indeed. So technically, the U.S. has already reached the debt ceiling. That happened early this year. Of course, as we've seen in previous instances where we've had these kind of standoffs, Treasury Department has ways to extend the deadline so they can take special measures. That's a process that we're now in. It's unclear how much longer that can go on. Most people expect that at some point, whether it's in the summer or into the fall, then the clock will hit the magic hour, and we'll have to have some sort of a resolution here. So at the moment, it does seem like both sides are still positioning. That seems to be what people in the market feel, that, well, this is something that will get resolved, but at the moment, there's no sign of how that will happen.
Yeah, don't discount the extremists in the Republican Party to push this to the brink. Bruce Einhorn, thank you very much indeed on that involving and evolving debate around the debt ceiling. Coming up, Turkey will start natural gas production from the Black Sea today. This as President Erdogan promises to cut the country's dependence on imports. That next, this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the Open. We are 54 minutes into the European trading day. Risk off across these equity markets, down 0.3% across European stocks. Futures in the US pointing lower by 0.7 on the E-minis. Bonds are bid. Let's get to a story in Turkey. Really interesting in terms of the energy space. Turkey to start natural gas production from the biggest field in the Black Sea. That happens today. President Erdogan has promised to cut Turkey's import dependence ahead of key elections next month, set to be his toughest electoral challenge in 20 years. Let's get the details then from Bloomberg's Patrick Sykes, who is in Istanbul for us. Patrick, what are the details then around the gas field, and what are the potential political implications for Erdogan as he heads up to those elections?
Hi there, Tom. Yes, big day here in Turkey for energy and for Erdogan. One of the pro-government newspapers this morning was flagging it as the start of the burning of the flame of independence, I think, which gives you a sense of how they're trying to frame it. It is a big field, 710 billion cubic meters. It's called Sakarya. And at peak production in a couple of years, around 2027, it should be able to provide around a quarter of what currently Turkey consumes in gas. Currently, it's heavily reliant on Russia and Iran. I was at the site just last week, and there's electoral messaging everywhere around this. The storage tanks where they've written, "We promised," all over them. The message being, this is a project that started with Erdogan's son-in-law a few years ago, and now we've taken it to realization despite the odds. Very challenging project from an engineering perspective as well. And here we are, just weeks before an election, presenting it to you.
Okay, Patrick, is there any opportunity that this gas will end up on the shores of Europe?
There is, though not immediately. Turk Petroleum, the state-run E&P company, has said that it would like to export, and has specifically said that it would like to export to Europe. There's no deals to make that happen for the moment, and I think it will be interesting how they balance that with the political imperative at home. So obviously, they'd love to export to those distant markets to get their income, but they also need to keep people happy and pay bills at home. And Erdogan's going to want to maximise the latter.
Patrick Sykes in Istanbul for us on that really interesting Turkish gas story. Thank you. Coming up shortly, we're going to be joined by Germany's Deputy Finance Minister, Florian Tonka. We're going to discuss the banking crisis, its fallout, and the European economy's outlook. Stay with us. This is Bloomberg.
York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York
the
City?
mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, and here's what's coming up on today's programme. The Fed's Beige Book suggests the US economy stalled in recent weeks as access to credit tightened. The mood is now firmly risk-off with Europe in the red. US Speaker Kevin McCarthy proposes a $1.5 trillion increase in the debt ceiling as fears grow that falling tax revenues could hasten the date of a potential default. Plus, Tesla slumps 6% post-market. That's as Elon Musk signals deeper price cuts despite the squeeze on margins. We bring you the pre-market share price in just a moment. And TSMC beats on net income, but forecasts worse than expected second quarter sales on fading demand. Let's check in on these markets then. As we said, firmly risk off. You're seeing that pronounced as well in terms of the futures in the US. You have a move into bonds. Yields are coming off across the curve. Commodities significantly under pressure as well around those recession risks. The Fed Beige Book flagging a stalling US economy. John Williams of the Fed saying that credit conditions are starting to tighten, but still saying more work needs to be done on the inflation front, and earnings not doing enough to convince these markets that corporates have the resiliency, at least for now, to weather a recessionary environment, with the caveat that it's still early days on the earnings front. Across the benchmark in Europe, you're seeing losses of 0.3%, 4.2 on the 2-year. That's a move lower by a little over 3 basis points. Euro dollar at 109, with people like Jeremy Stretch, calling for potentially 115 on euro dollar in the weeks and months ahead. Brent currently at $81 a barrel. That's a move lower by 2%. Look at that. Brent under pressure, squeezed again on those recession risks. Look at that picture on the map. Flashing red again as investors adjust to a slowing US economy, but with central banks still coming out and saying more work needs to be done to get rates higher and inflation down. And then, of course, you have to weigh up the risks around the default and the prospects that the clock is ticking on that in the US. US Speaker Kevin McCarthy proposing a bill that would raise the US debt limit for about a year and cut federal spending. Let's get the details then with Bloomberg's Bruce Einhorn. Bruce, how does this change the prospects then for this slowdown, this showdown in terms of the debt limit, how the two parties are squaring off, and how much risk now has to be factored in by these markets?
Well, Tom, Speaker McCarthy has said that the plan would be, as you said, to raise the debt ceiling until sometime next year, to have about $130 billion worth of cuts in discretionary spending. There would also be a limit on additional spending going forward. A couple of big question marks here, though. First of all, President Biden has adamantly opposed the idea of conflating negotiations over the budget with the debt ceiling. He says that the debt ceiling needs to be raised clean. After that, there can be discussions about the budget. He's also said the Republicans need to come forward with a specific budget proposal. So far, Speaker McCarthy has said, here's what we want to cut this amount, but he hasn't said where the cuts come from. That's where things potentially get very difficult. On the Republican side, McCarthy only has a pretty small majority. He can't afford to lose many votes. There are some Republicans on the more conservative side of his caucus who are adamantly opposed to raising the debt ceiling, who are opposed to the idea of any sort of return to even 2022 spending levels. On the other side, there are a lot of Republicans. In fact, the Republican majority really depends on Republicans who represent Biden districts. These are districts that President Biden won in the 2020 election, but Republicans flipped in the 2022 midterms. A lot of those Republicans are going to be very wary about pushing ahead with votes that could become very unpopular in 2024. So it's not even clear that Speaker McCarthy has the votes to get this through the House. That said, he has indicated that he'll be bringing this up to a vote possibly as early as next week. Even if it does clear the House, it doesn't have any chance in the Senate. So ultimately, there's not going to be a solution at the congressional level. It's going to have to be between the Republicans and President Biden.
Okay, Bloomberg's Bruce Einhorn on the opening gambit from the Republicans around this debt ceiling and the potential risks of a default in the US. Let's check in on Tesla, really one of the leading corporate stories of the day, of course, after those earnings, and particularly the commentary from Elon Musk and his chief financial officer around margins and their willingness to squeeze those margins further to build out and maintain market share. Pre-market then, you're seeing a knock of almost 7% to Tesla's share price. Again, margins coming in to 11.4%, down from 19%. A drop of 19% down to 11.4% for Tesla's margins. But here's the context, and here's what they stressed over at Tesla. Ford at 4%, GM at 6.6% in terms of margins. Tesla still has a healthy lead on margins. They are prepared to cut prices further, was the messaging, because they've got that margin buffer and they want to continue to carve out market share. Competition across the auto space as a result of that. There's the stock down 7% now on the back of the margin story out of Tesla. Now, the US economy has stalled in recent weeks with hiring slowing and access to credit narrowing. That is according to the Fed's Beige Book. It marks a step down from the tone of the previous report out in March, just before, of course, the SVB, Silicon Valley Bank collapse, which showed a resilient economy. The Beige Book likely reinforces the chances of a pause after a likely 25 basis point hike in May. Let's bring in Christine Aquino, Managing Editor for Bloomberg Markets today. Christine, thank you for joining us in the studio. Your take on the Beige Book then, the market reaction, risk off today, reassessing the recession risks.
Well, Tom, I think this is in some ways what the Fed was hoping / expecting after more than a year of a series of rate hikes, right? It is that slowing of the credit flow into the real economy. And the consequence of that is, yes, you know, some businesses might not be able to have as easy access to credit as they once did, especially if their financials aren't looking all that great. And so this is all consistent with a mild recession expectation from Fed staff economists that we saw from the last March minutes. But then how this kind of translates into perhaps a bigger problem and a harder landing than the Fed expects is via the jobs market, for instance, because as we know, a lack of access to credit for businesses, that could become a real problem, especially for some of them that employ a lot of people. And so if this credit crunch, turns more painful, then that could translate into mass layoffs, and what was once potentially just a mild recession could easily turn into something much bigger.
The real importance around focusing on those credit conditions and whether they turn indeed into a severe credit crunch. The importance, of course, for the corporate sector and households. Christine Aquino, thank you very much indeed on the Fed Beige Book and how markets are interpreting all of this. Let's get the Bloomberg First Word News now with Leanne Gerrans. Leanne.
Tom, good morning. Turkey is set to start natural gas production from the biggest field in the Black Sea today. State-run producer Turkish Petroleum says that Sakarya field will initially supply 10 million cubic meters per day. The news source gives President Erdogan an opportunity to slash energy prices less than a month ahead of key elections. By 2028, the field is slated to be producing enough gas to cover 3/4 of Turkish consumption. Now, Chinese banks have kept their benchmark lending rate unchanged after the country's central bank held back from easing monetary policy. The People's Bank of China maintained its one-year loan prime rate at 3.65% for the 8th straight month as the economy continues its recovery. Now, Elon Musk has signaled that Tesla is not done cutting prices after the company missed first quarter profit estimates. Shares in the EV car maker dropped in after-hours trade after the CEO argued there are good reasons for more price reductions. The base price of the Model 3 has now dipped below $40,000 over in the US for the first time in years. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Tom.
Leanne, thank you. Coming up, we're going to be joined by Florian Tonka, Germany's Deputy Finance Minister. We're going to discuss the banking crisis, the fallout, and the European economy's outlook. A really important interview. That is next. This is Bloomberg.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Tom McKenzie in London. Now, the past quarter has seen 3 regional US lenders collapse, if anyone needs reminding of that. But Wall Street majors, well, they have raked in gains with little sign of strain hitting the sector. Over in Europe, the spillover ended up in, of course, in a forced marriage of Swiss giants UBS and Credit Suisse. Investors now, in terms of their fears, hit Deutsche Bank. Those investor fears did hit Deutsche Bank, with prices for insurance on its bonds temporarily shooting up before coming down again. For more on all of this, let's go to Berlin. Oliver Crook is standing by and is joined by a really important guest who can give us a sense of the health of the German and European banking sector. Ollie.
That's right, Tom. Thank you so much. We're joined by Florian Tonkar. He is a member of the FDP. He's also a deputy finance minister here in Germany, in charge of financial regulation, in charge of financial markets and banking. So a very interesting and timely conversation. Thank you so much for joining us. Let's begin perhaps predictably on banking and market stability. Germany emerged relatively unscathed from the sort of chaos we saw in Switzerland in the aftermath of SVB. What did this episode teach us about the nature of risk and how it's changed for the banking sector?
Well, first of all, I don't think it's surprising that when you have two extreme situations in a very short time, the pandemic and then the extreme inflation, the sharp rise of the inflation throughout the world, that, of course, this has impact on the financial markets, and that the reaction of the central banks has immediate impact on financing conditions of banks and corporates. So it's not surprising that there are particular specific market participants which come under stress in such a situation. For us, it is very important to make sure that the overall system works, is stable. And I think we have properly ensured that through macroeconomic measures, we have required additional capital buffers for banks 1 year ago, clearly communicated. And we are, of course, alert. We know that we have to observe the market closely, but we don't have reason to believe that there is an immediate risk to financial stability.
And I think one of the things that made this crisis stand out from the others is the speed at which these things happened. And obviously, Deutsche Bank came under the crosshairs of investors for a day or two. There were some very big moves. It's obviously recovered all of that. But how did you view that move against Deutsche Bank, and how do you prevent that from happening?
Well, it was happening after the 81 bonds at Credit Suisse had been written down, and that, of course, caused some form of turbulence where equity for banks was repriced throughout the market. I think it teaches me that we have to point more to fundamental data of banks, which were well at that time and are continuing to be fairly well. So fundamental data have an importance, and that, I think, is what we must point at. And we must make clear that we have robust capital requirements. We will even increase capital requirements by the Basel implementation this year. And we have a robust crisis management, which we will further work on in Europe to make the authorities able to react swiftly and appropriately.
And as someone in charge of all of these sorts of things, how do you feel about how Switzerland resolved the issue with Credit Suisse?
Switzerland was under high pressure, of course. That was a global issue. And they, in effect, found a solution over almost only a weekend, which proved to be successful in the end and in effect. Therefore, I have high respect to what the politics, what the regulators in Switzerland have achieved. Of course, we must also point out in Europe the succession of how we would hold equity holders liable would be different. We would start with the direct shareholders, and only then would continue with the 81 bondholders. That would be the succession, the order in Europe. But that's one difference. In overall, the authorities in Switzerland have done a good job on that.
And obviously, another consequence of this crisis is that Switzerland now has a monster bank. Does Germany need a monster bank to compete on the international stage?
It is not for the government to comment on particular. Is
it something you'd like to see?
No, I think we need banks which are competitive. We need banks which are stable. We need banks which are profitable and successful. And size is not an issue or an asset as such. Quite the opposite, of course. Size also increases systemic risk, and therefore any solution which increases the size of banks requires particularly close attention of the regulators.
And Mr. Lindner this week talked about the soundness of the German banking sector, but he had also mentioned that some of the risk has migrated from those institutions into shadow banking. What exactly are we talking about, and how do you regulate, how do you address those risks?
So this is absolutely valid point. We need to look into the non-bank part of the financial market, the so-called shadow banking sector, because there, for instance, funds are extending loans, are extending credits in some segments of the market, have a high market share on that. And of course, they also collect money from funds from investors, which can be safer or less safe depending on how the liquidity management, how the governance of such a fund is. So the European regulator will be well advised to deeper look into the liquidity management, the stability also of funds of various sorts.
And I want to talk about the economy more broadly. So the recession fears have sort of eased up, but there's still obviously quite tight credit conditions here in Europe, and they're tightening and tightening. What's the risk to the German economy there, and how do you deal with that?
Well, it's a direct consequence, of course, of the very clear reaction by the central banks on inflation, which is necessary, which will continue to be the focus of the central banks rightly. The sooner we get inflation under control, the better for the economy, for the economic recovery. The longer, the more stickier the inflation is, the more disadvantage. So we support that. For the politics, for the German government, the consequence is now that we indeed need to complement the restrictive monetary policy also by a more cautious fiscal policy, no more debt, consolidation of the budget, reduction of the debt rate to GDP. Yeah. And that in consequence means that we need to create economic stimulus without fiscal implications. So this is less bureaucracy, quicker planning procedures, addressing the issue of skilled workforce in Germany. These are the factors which are relevant now.
And these are all connected to this idea that we've been talking a lot about in Europe, which is securing supply chains, which is also a euphemism for deglobalization, right? And this costs a lot of money. The United States has the Inflation Reduction Act. China's obviously been aggressive in the support of its companies and industries. Do you think that Germany needs to do more, and will it have to spend more money to achieve these aims?
Well, this is absolutely, it's a process which is already ongoing. I don't speak about deglobalization. We haven't seen any deglobalization over the last months or years, but a long-term trend is a slowdown of the speed of further globalization. But it's not going down, by the way. But we need diversification. We need various supply sources for critical minerals and for critical components. And of course, we will build up also a microelectronics industry in Europe, a battery, key components for future growth of our economy.
Florian Tonkar, Deputy Finance Minister of Germany, thank you so much for joining us. Back to you, Tom.
Oliver Crick, really fascinating interview. Thank you very much indeed. Joining us, of course, Anna Berlin with Germany's Deputy Finance Minister. Coming up, not looking chipper, TSMC's revenue outlook disappoints as the global tech slump continues. We'll get the latest next. This is Bloomberg.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned, that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome back. We're going to bring you live pictures. We are bringing you live pictures from Ireland and the inaugural Bloomberg New Economy Gateway Europe event. Bloomberg anchor Francine Lacroix is speaking with Lord Darragh, Kim Darragh, former British ambassador to the United States, also joined by former president of Croatia in a discussion about Europe's role in an increasingly fractured world. We're going to hear from more newsmakers at the event throughout the day, including panel discussions with the Irish Taoiseach Leo Varadkar and BlackRock's Vice Chairman Philip Hildebrand, as well as Ireland's Finance Minister Michael McGrath. That is all on Bloomberg TV and for terminal users at Live Go. Let's go back to one of the big corporate stories of the moment. Pre-market checking in on Tesla taking a hit after Elon Musk and the CFO reiterated their determination to continue to build out market share even at the cost of what were once very healthy margins. Down 8%, more than 8% on the back of that news as investors digest the commentary and the earnings coming through from Tesla. Don't forget their German factory and their US factory coming online as well, their Texas factory, I should say. And in terms of the margins, the context is they've gone down from 19% margins to 11.4%, so a huge drop. But the other part of that equation is that their rivals, if you look at Ford, they have margins of just 4%. GMM, General Motors, have margins of just 6.6%. So Tesla think they have room to go, that they have that buffer, and that they continue to push price cuts. That's what they think, to cut the margin and build out that market share. But of course, investors are not happy with that scenario. Checking on some of the individual stories, you've got Renault, L'Oreal, and Nokia. The earnings really not doing enough to support what is happening across the equities picture in the session today. Down 0.3% across the benchmark here in Europe. Futures pointing lower in the US, down 0.7%. L'Oreal is the one that remains in the green, up 0.5% in terms of the beat on earnings. Renault taking a hit, concerns about pricing there as well, currently down 6.4%. Nokia also coming in with a miss on its earnings. The telecoms infrastructure company down 3%. Coming up, surprise after surprise on the data front this week. Bloomberg UK will look at what the BOE is contending with. This is Bloomberg.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
DOJ or other authorities
could face bigger
Britain's next
was going to keep rate World Cup. This is a 3.
as the economic picture does.
The BOK is getting ready to make.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Good morning and welcome to Bloomberg UK. I'm Tom McKenzie in London. This week we focus on the UK's inflation problem and the headache it poses for the Bank of England and number 10 Downing Street. The latest UK inflation print has surprised to the upside. CPI in the year to March stayed in the double-digit range again at 10.1%. Wage growth for February also came in hotter than economists' expectations. Now, the pressure is on at the Bank of England. Policymakers, led by Governor Andrew Bailey, had previously expected both pay growth and inflation to cool. Bloomberg Economics has also scrapped its pause forecast. Our team now sees a 25 basis point hike at the next BOE meeting on May the 11th. With the data hotter than forecast, interest rate traders are also now converging on a terminal rate at around 4.85%, close to that 5% level. And a terminal rate of 5% is very much within the realm of possibility. So let's take a deeper dive into what the latest data means for policymakers at the central bank, in terms of politics as well, and bring in Anna Andrade, Bloomberg Economics' Europe economist, and Bloomberg MLive cross-asset strategist, Ven Ram. Good morning to you both. Thanks for coming in and joining on this discussion. Anna, let's start with you then. What is happening with UK inflation? We're the outlier now. I'm thinking of Europe, a little under 7% in terms of CPI. The US at 5%. We're at 10.1%. What is going on?
Okay, so just two different things with the data. The first one is that it essentially suggests that underlying cost pressure is much stronger than we anticipated. That's something we just have to recognize, and that was also reflected in the pay data. The comparison with the euro area and with the US, I don't think it's super fair. Well, with the US, just because it didn't face this massive energy shock that the UK still and Europe faced. And also with the Eurozone, in March, the Eurozone benefit from energy base effects. So this kind of effects that will mechanically bring down inflation in the UK, and that we will only feel them in April because of the off-gem cap. So that kind of explains a bit, you know, some divergence trends.
Okay, you don't think it's fair. There's the terminal chart showing where the UK lies versus its colleagues in Europe, in terms of the CPI, of course, and the US as well. So we are the outlier, but you're pointing to some important differences there. Anna, what is the Brexit effect on UK inflation?
So right now, I mean, so there's no doubt, and we've put some research out there saying that Brexit will have an impact on the economy. That's kind of clear in GDP and in investment numbers. But in respect to inflation, we just don't have enough information to say that it's Brexit. And I'll just add two things. One is on food. If you do look at food, the sort of surprises that you got in food inflation in the Eurozone and in the UK have been broadly the same throughout, 2022 and in the latest data releases. The second is core goods, and there could be, not sure if a bit of Brexit effect, but there you do see some signs of strong corporate pricing power, and that can make inflation more persistent. The BOE is worried about that. Whether it's due to Brexit or not, we cannot really tell. But so far in the data, there's just no obvious signs that it's...
Okay, from Brexit to breakfast, because we have the breakfast index, and we see the gauge has gone up, 23%. on a yearly basis. Of course, talking about the staples of every English home's breakfast. I mean, that is a complete stereotype. But nonetheless, sausages, bacon, mushrooms, baked beans, tea and coffee, all up collectively as a basket, about 23% year to date. Those gains are coming through. That is essential in terms of the inflation picture in the UK. Are we getting a sense, Anna, that those prices are anywhere near peaking?
It's a bit, there's some uncertainty there just because, producer prices for food kind of pointed to a downward trend, and that's just not been reflected. That was also the story in the Eurozone. So there's a bit of a question mark there. But I would say that we got more surprised on the CPI data. We got more surprised on the core inflation, which is the most problematic bit. So both services and core goods were actually stronger. And I think that's kind of where the BOE will be concerned about.
Okay, so they're concerned more about core than necessarily what's happening in food prices. Venram, let's bring you in. At this point, you've been pretty prescient in terms of your calls on UK asset prices as a result of the inflationary inputs coming through. Is it your assessment now that we're right to be pricing in close to 5% from the BOE?
I think we're absolutely right to be pricing in 5%. If you look at the real rate curve in the UK, Tom, we are doing just about 30 basis points on the one-year tenor. And this perhaps needs to move up to at least 1% for the tightening to bite. And what will cause that shift from 30 basis points to 1% on the real rate curve? You need a big move up in the nominal rate curve, so which means that 5% on the nominal benchmark rate from the BOE may indeed be required. If you look further out the real rate curve, it's also inverted. The key parts of the curve, the 5-year and the 10-year part of the curve are inverted. So basically they're at zero now, and those need to push higher as well for the tightening to bite. So net-net, we are indeed looking at a terminal rate around 5% for sure.
Wow, a terminal rate of around 5%. I just wondered to what extent investors have adjusted to that. In fact, households as well, as they look at their mortgages, Venram. I'm looking at the front end then, 380 on the 2-year, and you've been discussing and pointing to that bear flattening that we've seen. 380 on the 2-year, 382 on the 10-year. Then what does this mean? The ride-up in gilt yields, it's not happening today, but we saw a significant ride-up yesterday. And the views on 5% terminal rate, what does that mean for pound strength coming through in the weeks and months ahead?
Well, the pound has come back more than 20% from its lows last year. And we have known for a long time now that the UK economy is likely to slow this year. So, in other words, the pound is doing something different to what the economy is doing. So there is something driving the pound despite the gloom and doom. And what is that factor? That factor is the dollar weakness, broad dollar weakness, stemming from the fact that the Fed is approaching the end of its tightening cycle. In such a scenario, the euro will be bid, and the pound will outperform the euro. And this is the key thing that the markets have been missing. And I've been saying this from the start of the year, the pound is going to rally, and it's doing a 125 thereabouts now. But I do think that it's definitely got more upside in the months to come.
Yeah, you were the contrarian at the beginning of this year, Venram, with that call for stronger pound. 124, as you say, close to 125 on pound dollar. You had the view from Jeremy Stretch earlier, you get to 126. He's not really buying the view that you get 130 on the pound. Where do you think it ultimately tops out? Do you have a view on the next level?
I do think that 130 is definitely doable for sterling, particularly later in the year. I think what the markets are waiting for is confirmation that the Fed is going to stop. And if the Fed starts cutting rates, as the markets are speculating they will by the end of the year, I think that the dollar has big downside. That will push up the euro, and that will push up sterling definitely towards 130 levels.
Okay, Anna, if you align with the view from Venram that you get to potentially 5% on the terminal rate, but if you do, as a proposition, what do you think that does to the UK economy?
Yeah, so I think if we do get there, it's because the BOE sees that the underlying cost pressure in the economy is so strong, and that there's some sort of inflation. The inflation psychology has changed, that it needs to take rates that higher, because internal
sounds like you're skeptical.
Well, internal research from the BOE has pushed back on that terminal rate before in the trust period, and there's also internal research saying that at 5%, that's really when households' resilience starts to be tested. So I think that I do see like the risks of 4.75, like 4.75 is very plausible, but the bar to get to 5% is just a bit higher. Not impossible, but just a bit higher.
What does it mean for the housing market? It's already under pressure. Is the housing market able to slow without completely cracking?
Yeah, I mean, the important thing is really what we'll do to the economy. So right now, our call is for the UK that will dodge a recession. You know, we see the UK growing by 0.1% this year. The question is, if you take rates that higher, then you know, the second half of this year won't look as good, and neither will, you know, the start of next year. So there, we will potentially be looking at the recession there.
There's been a bit of head scratching from some people around the strength of the UK consumer, despite this cost of living crisis, historic cost of living crisis. Does that resilience, do you think, hold up into the second half?
Well, part of that resilience was probably driven by the fiscal support that we saw last year, and also the labor market strength that we've seen since the start of the year. I mean, last year we were probably expecting the labor market to be cooling much faster in this period than we are actually seeing. And we are now forecasting the unemployment rate to remain unchanged until the mid of this year. So this is, you know, strong wage growth, all of this recovering confidence that you are seeing in the confidence indicators. This is kind of propping up consumer. But once the labor market starts to tighten, you know, policy rates have kicked in, but they've not fully kicked in into the economy. Once that starts to happen, then the labor market will cool, and then, you know, maybe this consumer strength will be a bit weakened.
A cooler labor market, wage growth is accelerating, but still on real terms, of course, in negative territory. Does it pull more workers into the workforce? Does it address some of those participation concerns that we have around UK labour force?
Yeah, well, forecasting participation has been, you know, tough over the past months, just because we've been kind of constantly surprised with how tight the labor supply has remained. But it's true that in the latest data, we have been seeing kind of people coming back to work. So right now, I think we have 170,000 workers missing compared to the pre-pandemic. This was close to 500,000 in the middle of last year. So there's a trend that, you know, kind of suggests that, you know, the real income squeeze is starting to bite, and people kind of need to go back to work.
Okay, really, really great analysis. Thank you, Anna, for joining us in the studio on the topic of UK inflation and the prospects for the UK economy. Anna, Andrade and Venram from our MLive team with a view that maybe rates here in the UK get to 5%. Thank you both. Right, coming up, we're going to continue our conversation on the health of the UK economy. We're going to bring in Josie Anderson, Managing Economist at the Centre for Economics and Business Research. Joining us next, this is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, you know, pre-Giuliani in the early 90s. But we got to be careful, because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Sorry, they got it wrong. Hopelessly so. The evidence overwhelming. And it's puzzling in a way that the central bankers continue to resist this. I find I've been commenting on the Bank of England the best part of 50 years now. I have to tell you, the current lot are some of the worst I've ever commented on.
Okay, we're hearing there from Tim Condon, former advisor to Prime Minister Margaret Thatcher, and of course a famed monetarist in terms of his economic theory and thinking, talking and speaking to Bloomberg Radio. He also went on to say the UK is heading for a recession. Well, let's get some analysis then and some reaction in terms of what is happening across UK GDP. It flatlined, of course, in February on a monthly basis, though there was an upward revision to January's reading. The IMF has also warned that the UK is set to be the worst performing country among the G7 nations. Of course, the Chancellor of the Exchequer has pushed back on that view from the IMF and pushed back here with Bloomberg TV. Let's bring in now Josie Anderson, Managing Economist at the Centre for Economics and Business Research, for the analysis and the context. Josie, thanks for coming to the studio. Really great to have you in. Let's start with the GDP picture then. And we heard there from Tim Condon saying we're heading for a recession. The Bank of England's getting this all wrong. Money supply suggests that we're not only going to be coming out of inflation, he thinks we're getting into deflationary environment. It's an outlier view, but what is your take in terms of the shaping up and the outlook for GDP out of the UK towards the end of the year?
Well, GDP is an interesting one, actually, because the February data surprised on the upside. You know, we saw a strong January, no contraction in February, kind of a flatlining economy. So it makes a contraction in Q1 far less likely. You'd have to have had a really weak March. Now, that's still possible, but I think the big picture, rather than declining GDP, is flatlining GDP. You know, we can compare to 3 years ago, pre-pandemic, February 2020, and we've seen a tiny bit of growth, you know, 0.3%. So obviously we had the big recovery from the COVID contraction, and now the big picture in the UK is flatlining. So whether or not we'll see an actual decline in GDP this year is the big question. You know, will there be a recession? Prior to the February data, we're forecasting a 0.2 contraction over the whole of the year. I think it's likely that in our next forecasting round at the end of the month, we will have a slight upward revision, actually, because I think the UK economy has been surprisingly resilient. Consumers, despite this huge cost of living crisis, continue to go out and spend. So actually, yes, very weak GDP. We should be seeing growth. In the 3 years to February 2020, we saw 4.5% growth as a whole. And, you know, now we're talking basically low growth. But it's, you know, whether or not there'll be a recession is hard to say. It's flatlining.
So I want to unpack your views on where that relative resilience is coming from in just the next couple of minutes or so. But in terms of that stagflation view, or at least stagnatory view when it comes to the UK economy, as you project out to 2024, if you can do that, given all the uncertainty in terms of economic data, is this the near-term, the medium-term future for the UK economy, that we're going to be a flatlining, stagnant economy?
We do forecast a return to growth because ultimately, I think one of the main sources of this flat GDP growth is the cost of living crisis. And we are forecasting inflation to fall, and with that, consumers should be better off. But, you know, despite forecasting growth in the coming years, it's going to be weak. You know, it's not going to be a strong economy because consumers are going to take time to recover from this big cost of living crisis. And, of course, all the other shocks we've faced in recent years, obviously, we're still, to some extent, recovering from the pandemic and the associated supply chain issues globally, and also, of course, the war in Ukraine. So growth's going to be weak. And, you know, it's to do with the cost of living crisis. There should be a bounce back.
And inflation, of course, central to that cost of living crisis. 10.1% the CPI print. We're an outlier versus the US and Europe. What is your forecast now for inflation by the end of the year, with a government that has set itself a target of halving inflation by year end? Do they get to their target? What's your forecast?
Yeah, so actually consensus expectations were, you know, it would fall below 10% in the latest data, but actually we were expecting it to remain above 10%, but we are expecting it to fall over the year despite that. You know, there are lots of forces pushing inflation down. The main one is, of course, energy, and we should see that come through much more strongly than it has already in the April data and also in the second half of the year, you know, as the effects of the wholesale energy prices are passed on to households, which can take time in the UK because of our energy price cap and the way we work.
What about core? What about services, that component, and are the rate hikes that are expected to come through from the BOE, are they going to be enough to get that core down and away from its stickiness?
Yeah, so like I said, there is a big force driving inflation down, but actually on the other hand, it's sticky, as you said. So we're not forecasting it to fall dramatically. We're not forecasting deflation. I think it remained high in the data we got yesterday because it can be sticky, and it's sticky, because companies get used to higher price rises. They in a way can profit off it if they face relatively inelastic demand. And also, workers can bargain for higher wages in some industries. And there we see higher wage growth, higher than expected in the latest data. So that's where inflation can be sticky in the industries that can kind of get away with those increases. And so, we're forecasting an averaging of 4.5% inflation over the last quarter of the year. So yes, a halving, but
and that's
still high.
dependent on how many hikes from the Bank of England, because we were speaking to our rate strategist, Ben Ram, earlier on the show. He said he has 5% in view now in terms of the terminal rate from the BOE. Do they have to go that far to get inflation to your target?
Yeah, we're forecasting one more rate hike. We were forecasting that before
25
the data.
basis points?
25 basis points, yeah. So up to 4.5%, and then we're not currently forecasting any more rate hikes. I think, we were expecting, higher inflation in the March data, but we are also expecting it to come down. So April will be key for the decision after the next one. The Bank of England will really be looking for slowing inflation, but we are forecasting 4.5%.
And you think the door opens to cuts from the Bank of England before the year is out?
Yeah, right at the end of the year, possibly December, and no dramatic cuts. But if the Bank of England starts to see inflation falling and is dealing, with a very weak flatlining economy, it might start to think, how can we spur on some demand actually? Because right now it's kind of focused on getting that demand down, and it's hurting consumers, it's hurting households. But at the same time, that's the main method they have to deal with inflation. It is impacting demand and
Just
making consumers.
very briefly on the housing market, how fragile is that?
Yeah, so I think this is where one of the key areas where the UK is weaker than other countries, in that it has a stronger reaction to weakness in the housing market. And we are forecasting a fall this year of a 3.7% contraction in prices. That's an improvement on previous forecasts. The housing market, like the whole economy, seems to be more resilient than previously forecast, because obviously we have, we've had these huge increases in interest rates from the Bank of England, and that's impacting mortgage holders a lot. And so mortgages have become a lot more expensive. But yet, the housing market seems to have been quite resilient. But a contraction will impact, it has big wealth effects in this country. A lot of households will feel poorer if their house price falls. And of course, you get significant impacts on certain people. If they can't afford their mortgage anymore, they might have to sell their house.
Okay. Josie Anderson, Smart Insights. Thank you very much for coming into the studio. Josie Anderson, Managing Economist at the Centre of Economics and Business Research. Coming up, what European city are Wall Street bankers now banking on after Brexit? We'll give you the answer and why after the break. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Economics, finance, politics. This is Bloomberg UK. I'm Tom McKenzie in London. Now, for decades, London was the main nexus of European finance. But 2 years after Brexit became a reality, there's been a clear shift across the channel. That is the subject of today's Big Take. Joining us for the details is Bloomberg's Alex Rajbandari. Alex, is there really life after London then?
Yes, there is life after London, Tom, and it seems to be in Paris. There was a lot of debate after the Brexit vote about which city in Europe is going to win the big chunk of the financial industry that the city was representing for decades. And it seems like Paris has been getting a fair share of it. In terms of trading, it's become the main European hub for trading on the continent now. And banks have been pouring in talent and relocating people and hiring people here. When you look at JP Morgan, they have a 22-fold increase in terms of traders in the city. Citi is building a new trading floor. Goldman Sachs has a new building across, just a throw stone away from the Arc de Triomphe. So banks have been betting big on Paris, and now we can see there's a new ecosystem building around finance in Paris. And that's not just banks. Hedge funds have been following the trend. If you look at Millennium,
Does that momentum, does it have momentum, that kind of investment? Does it keep going, or do things like the protests that we've seen across France put a bit of a headwind on that?
Well, I mean, protests are quite temporary, and when you look at the decisions that banks have been making in terms of relocations and investment and loan books that were moved and transferred to Paris, eventually these are big decisions that won't be scaled back or scrapped just because of a temporary thing like a protest. And there have been protests in Paris, but the banks are making efforts to make sure that the people they relocate to Paris are settling in for the long term. They provide French lessons, they help them find schools for their kids. They're not just providing a 2-year stint in Paris. They are really looking to make the financial ecosystem here in Paris grow and see people get a career here.
Alex Rajbandari, on that shift then from London to Paris, it has momentum. Stay with us. Bloomberg Surveillance Early Edition continues in the next hour. This is Bloomberg.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person, I have to worry about my family, I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that We have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of a family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Everybody's anticipating that we're still going to have this tightening of lending conditions, tightening of credit conditions that takes place that reduces growth.
The real economy is much more aligned with these regional banks and small businesses, and they're expressing concern about getting access to credit.
We are expecting slowing of credit availability, but we're not seeing it creating this big cratering crunch in credit conditions.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Tesla's not done cutting prices on its electric vehicles. Elon Musk says the company can withstand lower margins, but investors are skeptical and shares are falling. Another sign that the slump in computer chips isn't going away. Taiwan Semiconductor, TSMC, forecasts worse than anticipated revenue for the current quarter. And New York Fed President John Williams warns that banking turmoil may make it tougher for households and businesses to get credit. Still, he says the system is sound and resilient. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And I don't know if it's the beige book wasn't beige enough, Matt, or it's the Tesla sort of sentiment hangover, but something's knocking futures this morning.
Yeah, and TSMC also not great news. I mean, the shares aren't doing poorly in Taiwan, or didn't do poorly in Taiwan, but you've got a slate of what looks like, down arrow stories. Credit crunch, not sure how crunchy quite yet. Tesla needs to cut prices again. That's bringing the entire sector down. And then you've got the possibility that the chip slump and maybe the chimp slump isn't quite behind us yet. In any case, stocks, after doing a whole lot of nothing yesterday, trading in a very tight range and closing basically unchanged, we see futures down now 0.8%. So that's a pretty decent drop in S&P futures this morning. Investors are buying government bonds. That pushes the yield down just a little. Remember, yesterday we were at 360, I believe. Right now we're at 356 on the 10-year. And then we see a whole lot of assets coming down. NYMEX crude off $1.36, now under 78 to 77.80. Bitcoin off another $400, now under 29,000 at 28,839. I think gold is just holding steady right now at about 2,000, but you've got a real risk-off mood. Take a look at what's going on in Asia, or what happened in Asia overnight. You saw the MSCI Asia Pacific Index closing down about 0.2%. And I wanted to highlight Taiwan Semiconductor first. We're going to talk about it in a little bit, right? Because the shares are actually up about 0.6%, but they've come down since the middle of March, from about 540 to 513 where they are now, and they cut their forecast for the full year. So there's maybe a problem in chips, but maybe we're bottoming out. I believe that's why you may have seen a bounce in Taiwan. The Nikkei gaining, but only 0.2%, and the dollar losing a little bit of ground against the yen. You can buy 134.67 right now. Anna, what do you see in Europe?
Yeah, we see negativity in Europe then, Matt. Certainly the auto story, we'll get to Elon Musk and what he's doing at Tesla shortly, but that's having an impact on some parts of the European equity space. There's that, and then there's the different readings you can give to the beige book. For some people, this put the emphasis on reduced credit, stalling U.S. economy. For others, it wasn't as bad as maybe they'd anticipated, but either way you look at it, European stocks looking on the downside today and moving lower. The French market, the German market, in particular, vulnerable to what we're seeing in autos and auto suppliers as well. So let's focus in on that sector and show you the weakness we've got coming through on autos. There's some specifics around individual ones. So the stock 600 autos index down by 3.4%. So it is broad-based. It's got some auto suppliers in there as well as the manufacturers of the cars themselves. One of those manufacturers really coming under pressure, down by 7.4% for Renault. And this is a business that, yes, is affected by the sentiment from Musk and the price-cutting narrative, the pressure on margins there, but also the fact that they put out earnings and the first quarter numbers actually look better than the market had anticipated, but the Musk story dominates. I put in Stora Enso. This is a packaging business in Finland that we don't talk about all that often, but it's down by 2%. And what drew my attention to this was the fact that they said that all areas of the packaging market are currently weakening, which seemed like an interesting take on one part of the global economy. And L'Oreal's a really interesting story as well. The French cosmetics and beauty products manufacturer coming through with numbers that pleased investors, it seemed, even though they weren't able to do as much business in the first quarter in China, not because there wasn't the demand, but because they didn't have the merchandise in place. A nice reminder of just how surprised we were at that Chinese reopening story at the time, and the way that it might have left some businesses a little off-center when it came to the start of this year.
All right, so we'll continue to watch that and talk about what's going on in the luxury and the makeup space, which has been highlighted over the past couple of days. Let's get to the car story, though, right now. Some calling it a tech company, but basically their business is making and selling cars. Elon Musk signaled Tesla will continue to cut prices to stoke demand for its electric vehicles, even at the expense of his fat profit margins.
While we reduced prices considerably in early Q1, it's worth noting that our operating margin remains among the best in the industry. We've taken a view that pushing for higher volumes and a larger fleet is the right choice here versus a lower volume and higher margin.
For more, we are joined now by Craig Trudell, our global autos editor. Craig, you know, we've been talking about these margins, and they were pretty amazing, I think 20% last year, but they've come down by about half. How much more can Elon Musk cut prices?
Yeah, I think that's the question, right? You heard the case from Tesla going into these earnings that there wasn't going to be a choice, right? That you could have both, that you could have growth and these really huge, these really substantial margins. And I think what we heard from the company last night was something very different. This idea that, you know, they're very much willing to see these margins, you know, shrink beyond what they have already. And we kind of knew that going in, right? We had 2 rounds of price cuts already this month, so we knew that that's going to, you know, really pressure the second quarter numbers. And I don't think we got any sort of assurances that they're done. If anything, there was, you know, sort of further signaling that that there's more to come here, and that, you know, they're motivated really to bring their lineup, down to the level that more people can afford them.
What's going on with European car stocks then in response, Craig? Is this in response? I mean, we see Renault down by 7.7%, Volvo cars down by 5.4%, Stellantis, Faurecia, both down by more than 5%. So this is autos, it's the suppliers to autos, a real area of weakness today. Is this something that Elon Musk said on the call, or is this something else?
I think if you look at Renault, they have started to roll out some electric vehicles, but they have a lot more coming, right? And some of these are in the segments that you would sort of expect Renault to play in, some of the more mass market segments. And when you see the Model 3 going much lower and sort of indications or hints that they're not done cutting, that really is a sort of cause for concern if you're Renault, in the sense that, even while it's kind of ironic, the first quarter numbers were actually, pretty solid for them, but it's really more so about the outlook, and they got a lot of questions, really kind of a drubbing as to, what's the outlook for your EVs going forward. I don't think they necessarily gave the answers that the analysts or market was looking for.
Okay, so it's about the outlook and that competitive environment then in the wake of Tesla. Craig, thank you very much. Bloomberg's Craig Trudell with the latest on the auto space. Let's go to chips. TSMC has forecast worse than expected revenue for the current quarter, reflecting a persistent slump in demand at the chip-making giant. Bloomberg's Alex Webb joins us now with the details. But Alex, they're sticking to their CapEx plans. So what is the overall story here at TSMC?
Well, they are very much the key bellwether in the tech industry when it comes to understanding what electronics consumption looks like right now, and also what their customers are ordering. You find their chips in smartphones, in computers, in cars, all over the place. At the moment, it's not looking very good. They did beat expectations for the March quarter, but they had already cut their forecast of that, so expectations were pretty low. Looking into this quarter, they are below expectations in terms of forecasting what they say this quarter is going to be like. They are more optimistic for the second half of the year. Second half of the year, of course, is when we start to see new iPhone models. That is, one of the biggest products that they supply chips for. Perhaps then they're also looking for greater demand as a consequence of some, economic measures as well.
In terms of, sorry, Alex, the one thing I'm thinking when I look at the shares, right, they're up a little bit, and I know that they've come down from a higher level, but is it possible that this at least signals to investors a bottom is getting put in?
It's very hard to tell with a company like TSMC. They've not been trading from a multiples perspective significantly above the rest of the market. They're facing increased competition as well. Now, obviously, that takes longer to come in, but Intel is really coming for them at the moment. Whether they can do that, huge question. The glimmer of hope that investors are looking towards and that TSMC is trying to feed them is the prospect of AI, that actually you need advanced chips for AI to work at the bleeding edge. We are now seeing some of that, as we've seen with ChatGPT and plenty of other examples, come into the public domain. That is the glimmer of hope on the horizon for a new leg of growth.
And definitely something that PR spinners around the world are feeding to journalists for sure. Alex, thanks so much for joining us. Bloomberg's Alex Webb talking to us about TSMC, a bellwether that we're all watching very closely for chips around the world. Now let's get to the Fed's beige book. Not quite as boring as the name would indicate. It says that the U.S. economy stalled in recent weeks, with hiring and inflation slowing and access to credit narrowing as well. New York Fed President John Williams echoed that sentiment. Listen in. Actually, you know what? I'll just read it. The banking system is sound and resilient. Nonetheless, these developments will likely lead to some tightening in credit conditions for households and businesses, which in turn will weigh on spending. Sorry, that was not a sound on tape. That was just a rip. Joining us now is Ven Ram, Bloomberg Markets cross-asset strategist. So, Ven, this just adds to a lot more signs out there that we're looking at the possibility of a credit crunch.
Morning, Matt. Yes, it definitely does. Maybe we shouldn't call it the beige book. We should call it the book that is still going fast from green to red, green to amber to red, shall we say. Look, there is no question that the U.S. economy is losing momentum and losing momentum rapidly at that. And we will get a readout of the April PMI numbers tomorrow, so we will get confirmation of that. My own suspicion is that this long tail of the economic expansion will lag simply because of the strength in the labor market. So I don't think we are going to get into contractionary territory by before the autumn. So until then, we'll muddle through these numbers. And after that, we are going to get a slowdown. The question is, how severe is the slowdown going to be and how protracted it is going to be? And we don't know those contours just yet.
Yeah, we don't have the answers to those things. We look for clues always. Ben, good morning. So Matt sent me a story on corporate bonds, which I thought was interesting, putting fallen angels front and center. It seems that corporate bonds are being cut to junk, which is what a fallen angel is in the corporate bond space, at the fastest pace since 2020. And of course, 2020 stands out for obvious reasons. You have to go back to 2016 and 2009 to find periods where the rate of creation of fallen angels was this high. Does this worry you, Ben?
Morning, Anna. I don't think it's a big concern as of this point because it's an expected outcome of the Fed's tightening cycle. The Fed has tightened rates phenomenally in this cycle, much more than it has done so in decades. So what we are seeing is a reflection of the tightening. And, you know, it is natural for credit rating companies to lower the ratings of these companies because you know, their debt serviceability at higher and higher levels of interest rates is being called into question. But if the U.S. economy loses momentum, as we just discussed, and if we go into a soft patch in the economy later on in the year, I think these corporates will get some respite. So there is no evidence of any systemic crisis as of now, and we are all hoping that that will remain the case as the year progresses.
One thing we can say for sure is that borrowing is getting more expensive, Ben, and especially for banks buying these high-grade credits, they're going to be demanding more of a risk premium to own this stuff. Ben Rahm from Bloomberg's MLive blog, thanks so much for joining us. Take a look at some of the stocks that we're watching in the pre-market today. There's a lot going on under the hood. First off, the casinos, led by Las Vegas Sands, but also watch MGM and Wynn. They have been moving in the pre-market. LVS reported after EBITDA, property EBITDA, adjusted property EBITDA, they have a lot of caveats there, rose and beat the average estimate of analysts. So $792 million was what they had. That, you know, quintupled from what they had the same time last year, but the street was looking for $605 million. So still doing a lot better than the estimate. As I said, watch the others to move in sympathy. We did see Wynn Resorts move in the post-market yesterday. It's not doing anything in the pre-market this morning, but MGM is up about 0.4%. IBM also gave a forecast for annual revenue that was in line with analyst estimates, delivering a cautiously optimistic signal about technology spending at a time when some of its peers have been cutting guidance. And this is just one more sign, I think, if you added TMC, that maybe the bottom is in this quarter. TSMC said that they feel like that's what the case is, and maybe that's what investors are taking away from IBM as well. Those shares up 2% in the pre-market. And then Anna mentioned European car makers. Look at U.S. car makers, one of which we share, right? Stellantis is listed here. It's also listed in Italy. It's also got probably a Dutch headquarters. They're global, right? But Tesla and its announcement that it's going to continue to cut prices to take market share, that's hit that stock, which is big and going to drag on the indexes. But you also see Stellantis off 5%, GM off 2%, Ford off 2%. So this is a concern for the entire industry, Anna.
Yeah, absolutely. We're certainly seeing the pressure on, as you say, the auto sector here in Europe. Coming up, Christian Sinding joins us, the CEO of the Swedish private equity firm EQT. We will talk about what valuations look like from his perspective right now. We'll also get an FX perspective. Esther Reichelt joins us, Commerzbank FX strategist. She'll be on deck to give us her thoughts on where the dollar goes from here, the pound, the euro, and much beyond. Plus, it is day 2 of the Bloomberg New Economy Gateway event outside Dublin. Today, we'll be hearing from Ireland's Prime Minister, Leo Varadkar, BlackRock Vice Chairman Philip Hildebrand, and Ireland's Finance Minister Michael McGrath. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, in a tough environment for private capital, one of Europe's largest private equity funds, EQT, has had a stellar first quarter with deal activity picking up. Joining us in London is Bloomberg's Danny Berger with the CEO of Swedish private equity firm EQT. Danny?
Matt, thanks so much. That's right. I'm here with Christian Sinding. Christian, thanks so much for joining the program this morning. I know you just finished your analyst call about an hour ago. And look, the numbers here, deal activity picks up to $5 billion. You're still bringing in a higher AUM of those fee-generating assets, but your shares fell as much as 2% this morning. Now, I know you're going to tell me you don't care about the share price, but why do you think there's been a slight reaction, perhaps, of disappointment?
Yeah, I think, can you hear me okay? I'm getting a little bit of a fuzzy feed, but if you hear me fine, that's great. Yeah. No, you know me, Danny. I won't comment on the stock price, but if you take a step back, I think investors are still uncertain about what's happening in the global economy and the global capital markets. And therefore, we who are working with transactions, investments, and exits are part of those cycles. I think what's important to us is that we're now putting capital to work again in interesting companies and interesting buildings, and we see opportunities to create long-term value for our clients, and that's ultimately what's going to drive the valuation of EQT.
Right, in your earnings statement, you talked about the fact that you are seeing deal activity pick up at the start of the year. How far away are we at this moment, Christian, to having a more normal deal environment?
Oh, I wish I knew. What we're seeing in the market is still, it's still complicated. The financing market is open, but still not open for larger transactions, and probably about $2 billion of financing in Europe and about $4 billion of financing in the U.S. A bit larger than that in infrastructure, which is inflation protected and has more robust downside. If you look at the exit side of the equation, the IPO market is open for medium-sized and smaller companies, but it's not open for the larger transactions. So the larger deals, like some of the bigger companies that we own in our private equity infrastructure business yet. So I think right now it feels like we're in a period of some people are saying no landing, and that probably is going to be it's going to be like that for a while in our expectations. So what we're trying to do is to find the right companies in the right sectors, put capital to work with those, and build long-term value.
And in this environment, it's one of uncertainty. Do you think public equities are too richly priced right now, given all of that?
I think it's hard to say. If I look back, I think it's the corrections that you've seen in growth, very high growth businesses where valuations were extremely difficult to understand. some of the biotech market, the fact that the SPAC balloon has been punctured. I think that's actually quite positive. It brings some more resilience and grounding to the capital markets, and that's the time when we can start to do transactions. So we're now in an active dialogue on a number of public to privates, and those dialogues are intensifying. So it looks like sellers and buyers are starting to come together between the private and public market, and maybe that's also a sign that the public markets are, reasonably valued. But if I knew that, I probably wouldn't be in the private markets.
Well, part of the reason I do ask is because of the take privates, Christian. As you say, of course, DEKRA, the pet med veterinarian company, that one, I should say, it is a pretty expensive valuation, about 72 times EBITDA. When you're looking at some of these take privates and you say, hey, I like this company, but it's a challenging environment, we're holding on to things for longer, how do you approach these kinds of companies when you are having to pay up in order to acquire them?
It's a really good question. What we do is we build. Well, first of all, we take a step back and say, do we want to be in the sector? And we're big investors in the pet sector. We're big investors in healthcare, and this kind of brings both together. So the secular trends behind that industry are very positive. And then you have the company itself. We think has a lot of potential for future growth. I can't really comment anymore on that. It's still just early stages. But the mindset more generally is that, we believe that it's our job to find the right sectors, the right subsectors, and the right companies in those, and take a really long-term mindset. And then hopefully some of those transactions will go through during this next cycle.
Right. Well, I mean, you see it around London. Basically, everybody has a dog at this point. So I understand those sorts of secular trends. Christian, before we let you go, last year you made an acquisition for Barings Private Equity Asia. You've talked about before this idea of the difficult fundraising environment. Do you think at this point in time, you and your peers, in order to attract investors, you just got to be bigger?
Yes, there's a clear trend in the private market space of, like in other professional services and banking and consulting, et cetera, of a consolidation. There's something like 7,500 private markets firms in the world. But over time, there's going to be 10 or 12 or 15 or whatever it might be, large global players, of which we're one. I think we're maybe top 5 in the world now or something like that. And those companies are able to put a lot more resources into the thematic investment strategies, into value creation strategies. We've had an AI program for a long time now. We're accelerating that with generative AI and global capabilities, so you get global insights into sectors, and putting that all together in multiple different asset classes around the world, and being able to receive larger amounts of capital. So if you look at this last fundraising cycle, 57% of all capital raised in private markets went to the mega funds like we have. So that trend is accelerating, and of course that's also going to drive some future M&A in the market as well.
Yeah, got a feel for the small guys in this environment. Hey, Christian, really great to catch up with you today. That's Christian Sinding, CEO of EQT. And with that, Matt, I'll toss it back to you.
All right, Danny, thanks very much. Bloomberg's Danny Berger talking with the CEO of EQT. Now keeping you up to date with news from around the world, here's the first word. Democrats are rejecting House Speaker Kevin McCarthy's proposal to raise the debt limit for about a year and cut government spending. The plan would increase the debt ceiling by $1.5 trillion. It would also cut discretionary spending by $130 billion. If the debt limit isn't raised, the U.S. could default on payment obligations as soon as June. The U.S. Supreme Court has extended access to a widely used abortion pill until at least Friday. Justices are considering whether to allow restrictions, on the drug to take effect. A lower court in Texas has ruled in favor of abortion opponents who want to roll back FDA approval of the pill. And inflation is making life harder for British consumers. The price of a full English breakfast has jumped to a new high, according to the Bloomberg Breakfast Index. The average cost of ingredients is up almost 23% from a year earlier in March. The price of milk rose 40%, while bread increased 33%. I would pay you, Anna, to take the mushrooms.
Yeah, absolutely. I wonder if there's been a reduction in heart disease as a result. Esther Reichel joins us. A look at FX markets next. This is Bloomberg.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned, that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Story.
story.
Is there the kind of upside?
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Tesla's not done cutting prices of its electric vehicles. Elon Musk says the company can withstand lower margins, but investors are skeptical and shares are falling. Another sign that the slump in computer chips isn't going away. Taiwan Semiconductor, TSMC, forecasts worse than anticipated revenue for the current quarter. And New York Fed President John Williams warns that banking turmoil may make it tougher for households and businesses to get credit. Still, he says the system is sound and resilient. I'm Anna Edwards in London with Matt Miller in New York. And Matt, it seems negative sentiment coming from somewhere, from the earnings story, maybe around Tesla. That's certainly weighing on sentiment here for the auto sector. Also the beige book, all of that adding up to a negative futures picture.
Yeah, absolutely. I think there are concerns about credit availability, credit tightening, and of course the car makers are down on both sides of the Atlantic. They're getting hit pretty hard here as well. Tesla itself, not a small company, so when it's off 7% or so, that's bound to drag on the broader indexes. Check out futures right now off about a little less than 0.75% on the S&P. It should be said that the S&P did a whole lot of nothing yesterday and the day before, so it's hovering still at over 4,100 in the cash trade. Maybe some of those gains are going to be given back this morning. We have had yields rising pretty steadily over the last week. Now it looks like that's turning around as investors buy U.S. U.S. Treasuries. So 10-year yields down again below 360 to 357.56. And NYMEX crude falling once again. You know, it rose up to $83 and change last week. Yesterday it was back down below 80. Today it's down below 78. So there's a real question of demand here, because even as OPEC Plus continues to cut production, at least announced production cuts, the price of crude just can't stay, NYMEX at least, above 80. Of course, Brent is up there, but probably coming down to that big round number itself. And then Bitcoin, a second day of drops. It fell below 30,000 yesterday after coming back up on Tuesday. Now it's below 29,000 at 28,876. So still a pretty hefty price compared to the 16 grand that we saw after the collapse of FTX, but it is slowly moving lower. In terms of pre-market movers that are moving higher, we do have Las Vegas Sands up 4.5% in the pre-market after reporting adjusted property EBITDA, so operating profit at its properties adjusted for last year for comparability. It beat the average analyst estimate by a heck of a lot. It came in at $792 million, and the street was looking for only $605 million. Watch Las Vegas Sands and its peers. IBM gave a forecast for annual revenue that was in line with analyst estimates. Not terribly exciting. It was cautiously optimistic about technology spending, but a lot of its peers have been slashing guidance. So maybe IBM is doing better than the rest. As a result, in the pre-market, it's up 1.5%. And then Tesla, as we've been talking about, signaling more price cuts ahead. Its margin halved from 20% last year to 10% in this quarter, and now the shares are down another 7.5%. Anna?
Yeah, really fascinating, the Tesla story, and that's certainly echoing across the Atlantic then, Matt, putting pressure on the auto sector. This is the picture for broad European stocks as a whole, down by 0.3%. The auto sector really stands out. We talked about Renault, down by more than 7% earlier on. Some of the suppliers, too, it was not just Renault, though, Stellantis as well, and some of the suppliers for the auto industry really under pressure. So as a whole, that sector down by more than 3%. The French and the German markets a little weaker as a result. This is an interesting one on the global economy. Stora Enso makes paper and packaging, and their numbers, they guided lower in terms of what they'll achieve on EBIT this year because of costs, and it's the things you would expect around energy and chemicals and the like, but also around demand. And they said that all areas of the packaging space, of the packaging space that they supply, all areas were coming under pressure and were weakening at this time, which seemed interesting. L'Oreal up by 0.7%. So in a lot of geographies, they pleased with the sales numbers they put out after the bell yesterday. But on China, they disappointed, but maybe for the right reasons. They could have sold more in China. They just didn't have all of the merchandise available because of the speed of the reopening story that we covered, of course, at the end of last year, Matt.
All right, definitely one that we're going to continue to watch, one we've been talking about for a couple of days now. Both, I think, luxury and specifically makeup have been in the spotlight. I want to go, though, from there to FX, and I can't think of any decent transition. Joining us now is Esther Reichelt, Commerzbank FX strategist, to talk about, the effects of central bank policy, central bank credibility, and credit tightening on currency pairs. Esther, first off, what do you make of the hiking cycle around the world? It seems to be reaching its peak. Certainly, we expect the Fed to raise one more time and then hold. That's kind of consensus. Is that your view as well?
Well, yeah, our U.S. economists still see the potential for further rate hikes. I think everybody will be focused on the data that are coming out over the next weeks, in particular the GDP data for the United States, of course. But of course, we are clearly hearing more cautious voices from the Fed, and I think so this sentiment, this cautious U.S. dollar sentiment, will prevail into the Fed meeting in May.
And the ECB is a different story, though, right? Because they could raise 50 or 25 at this next meeting. Who knows what they'll do at the meeting after that? Is inflation stickier in Europe?
Well, absolutely. I mean, we have seen inflation numbers being much higher, coming down slowly here in Europe. Like the alarm bells got off again yesterday after the high UK numbers. And we are also hearing a much different rhetoric from the ECB. You know, like nobody is talking about an end of rate hikes. It's rather being discussed, will it be 50 or 25 basis points right now? And of course, this is supporting the euro. However, we still have to remember that the doves are immensely powerful within the ECB. And I think as soon as we are seeing signs of a slowing economy, signs of inflation data, of disinflation, of core inflation leveling off, I think the doves will take over, and I do not believe that, you know, like the ECB rate hiking cycle will continue for much longer than into summer.
Okay. Esther, good morning to you. So the doves might take over. Interest rate differentials might start to play in a little more as well. I mean, clearly we've seen the euro gaining because of expectations around those differentials and the gap maybe between the Fed and the ECB closing. If the ECB continues hiking after the Fed has paused, how much do you think that the ECB can go on hiking, even if we see sufficient weakness in the US economy that we see a pause from the Fed? I ask this because Klaus Knot at the ECB is saying they might need to hike again in June and in July.
Well, Klaus Knot is certainly the most hawkish member, and his view will not reflect the consensus within the ECB. However, I think the euro has already gained substantially, and I think any more upside in euro dollar will most likely rather come from the Fed side. That means, like, if the Fed is indeed moving towards rate cuts, I think this is more likely to push euro dollar higher than much more upside on the ECB side, because, as I said, this is most likely to be limited due to the strong power of the doves within the monetary policy board.
Yeah. How do you think that the pound will continue to price in the Bank of England expectations and the latest data around the UK economy? Esther, I asked this because yesterday we saw a great deal of volatility in the pound. We got that inflation data, which in some circumstances might have just caused the market to buy the pound on the expectation of higher interest rates. But then some people took a pause and thought about maybe the weaknesses, the weak areas of the UK economy. How would you expect the pound to trade from here?
Yeah, the pound is really a very specific factor because there are also very strong idiosyncratic factors to these strong inflation numbers, and due to the Brexit, of course. And what we've seen, however, over this whole rate hiking cycle was that the Bank of England always remained rather cautious, rather reluctant. They were always delivering what was needed to keep the inflation outlook in check, but not much more. So they weren't very active in bringing inflation down, but rather waiting for time playing out for them. And we actually believe this most likely to continue. So yes, yesterday much more rate hikes were priced in, but the Bank of England really has to deliver for the pound to sustain the gains we have seen. We rather see potential for some more weakness, given that the Bank of England had been so cautious and was actually waiting for an opportunity to pause rate hikes. So I think this overall more cautious sentiment will actually be more dominant driver in pound sterling exchange rates going forward.
You know, I want to ask about the dollar broadly, because we've seen the Bloomberg Dollar Index come down significantly from its peak last year. We were up at 1353, I think was the high, and now we're trading down at 1226, 1227. Is consensus for a continued drop in the greenback? I mean, is it going to continue to fall against major currencies it trades against around the world?
Actually, I don't believe so. I mean, simply because there is already so much priced in. You know, like the market is already expecting these rate cuts. Yes, we'll most likely see some more US dollar weakness as soon as the Fed is also moving towards these rate cuts and start discussing them. So then we are going to see some more US dollar weakness. But in general, the view that is currently priced into the FX market, in particular into dollar exchange rates, seems to be rather viable or rather feasible, given the economic and inflation environment we are seeing in the United States, and of course the uncertainty that's still dominating, in particular with the view on how credit, or whether we are going to see a credit crunch or not.
I can ask you about something that we don't talk about very often. That's the Hungarian forint, Esther, and it's doing a whole lot of nothing today. But yesterday we saw substantial weakness on some comments that looked like we could see more political pressure on central bankers to cut rates. Is that something that interests you, Esther, either in the way that the HUF trades or in the broader theme that it represents?
Yeah, absolutely. Because actually yesterday's movements have confirmed us in our very cautious view with regarding the forint, given this lack of credibility of the central bank, or rather this, like unclear view on the central banks, because the Hungarian central bank has always been criticized of not, not sticking to a tight monetary policy long enough. And we are also seeing political pressure from the government side to cut the rates, because they have hiked rates considerably. However, then they have moved to a less transparent interest rate system. And yesterday, was actually an indication, because, the central bank once again signaling maybe the potential for rate cuts. This actually confirms our view that the market is right in being, very skeptic about central bank credibility in Hungary. And we believe as soon as this whole uncertainty about the banking sector, this uncertainty about the inflation picture, as soon as this levels out later this year, the Hungarian central bank will move to an easier monetary policy and thus weighing on the forint.
Okay, Esther, thanks so much for your time. Esther Reichelt of Commerce Bank joining us to talk about all things FX. Coming up, more US regional banks out with earnings today. We'll preview what to expect. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We are not in a banking crisis, but we have had and may still have a crisis among some banks. I believe strong regulatory intervention on both sides of the Atlantic led to the cauterization of the damage. I consider the current issues as not remotely comparable to 2008.
That was James Gorman there, CEO and chairman of Morgan Stanley, speaking after the company reported profits falling from a year ago amid a slowdown in investment banking that, we've all really been watching. Meanwhile, regional bank earnings continue rolling out today with East West Bancorp, Comerica, and KeyCorp all on deck. Investors are going to be looking for signs of contagion or healing from the recent turmoil in the financial sector. Shonali Basak, our global finance correspondent, joins us now. So where do we focus?
Listen.
Big banks or the regionals? I mean, they're both exciting stories.
It's time to move to the regionals, and it's because we're still watching the deposit story, but we're also watching other things like pressure on net interest income, profitability, exposure to commercial real estate, and other kind of risky areas. We saw from Ally, for example, that there are more worries about auto that are still building in the market. Questions about the housing market as well, because remember, when you look at the biggest banks, the loans tied to mortgages are really, really falling off a cliff. They have been falling significantly. But data yesterday shows that some housing prices are really starting to cool. So when does that start to turn around, even with higher rates that we're looking at? So really, it's profitability alongside of stability of the banking system that we're looking at, Matt.
So, you know, what's interesting to me is whether or not we're going to see competition for higher deposit rates, right? My local bank is still giving me 0.02%, but a lot are offering 4 or 5% in higher yielding accounts.
Apple, Goldman.
Exactly. Is that going to hurt, you know, these banks' bottom lines? You talk about net interest margins.
Yeah, and it's also the cost of funding. And it's not even just the small regional banks. That was the worry about things like Schwab as well. So, yes, I mean, the short answer is there's a real worry about the cost of funding as we move over, especially when you look at the larger banks and not only how stable they've been. Morgan Stanley brought in $110 billion worth of net new money yesterday, or in the first quarter. You also had JP Morgan saying net income is rising, net interest income is rising by the billions of dollars. I don't see that kind of message coming from everywhere else. Again, this is not just about the deposits, the idea to lend into this economy and the provisions ticking higher, Matt. Remember, charge-offs are starting to also rise as well. So that profitability pressure is the next thing that people will turn to. Some of these stocks had significant recoveries, and not just the stocks, the bonds as well. Just think about Western Alliance, which was trading 50 cents on the dollar, give or take, and has risen by more than 20 cents, almost 30 cents. So people who bought those bonds at the low are really, looking at some substantial gains there. Yes. I mean, listen, though, what's interesting about that, though, I talked to some investors yesterday about whether they would be trading the debt and equity, and they said, listen, until we get through this season, we're still kind of concerned, which just shows you that there are still jitters in the market here when you look at kind of the end game for where these banks are headed.
Right, and thinking about what we've learned this week, Sonali, and there's been a lot in terms of the big bank story. Morgan Stanley was the last of the big names to report, and a real focus on something else that maybe wasn't in focus at others. That's the wealth management story and success there.
I think it's fascinating because, and like we said, they wanted a lot of net new money. They also kind of said that net interest income was not going to expand more meaningfully in the coming quarters ahead. But with that said, I think James Gorman called it a monster. It's such a large giant in Morgan Stanley's business lines now. But remember, what's interesting is you see Goldman also trying to focus on asset and wealth. JP Morgan also a large asset and wealth business with some of the best returns in the entire company. People forget to look at the ROE within those businesses. They're quite large. So all the banks report that business very differently. But remember, I think the point you're making here, Anna, is in that business, there is also lending and there's also deposit taking. So banking to high net worth individuals has certainly been a larger and larger trend, and a flock to the larger regionals where you see more of the success in lending and in terms of deposit taking as well.
And I think we carry on with some big names in the financial services sector with Blackstone numbers due out.
Yeah, it's time to look at the whole picture, right? We have to start looking at the credit card companies. We have to start looking at the private capital firms. Remember, private capital has been playing a huge role in these banking tremors, right? James Gorman is saying it's no crisis anymore. And so if you look at what private capital is doing, these private credit markets are not just filling in holes in corporate credit. Now you have a lot of these types of firms, Bloomberg has reported over and over, that are trying to find ways to pair with these regional banks, provide capital solutions to these regional banks. We'll also want to hear from Blackstone about the commercial real estate sector at large. In prior quarters, they've already taken some write-downs on the small portfolio of offices they already have. We've seen them default on some smaller portfolios as well around the world. But listen, really, John Gray's word about the real estate market and how much more pain there could be ahead is a big signal ahead.
When do you talk to John Gray?
8:30 today.
8:30 today. All right, we're going to tune in for that for sure. I just want to quickly talk about, you mentioned the cost of funding and corporate credit, and there was a great story on the Bloomberg overnight that banks are going to need a higher risk premium. They're going to demand more to lend money to corporations, and that's going to just push spreads wider and wider
And it's
companies.
not just corporations. I think both corporations and institutions. If this was a market that ran on leverage for however many years, then what happens is that cost goes up. A lot of the hedge funds and institutional investors have a lot of very levered trades in the market. So yes, the cost is certainly, if the cost is going up for the banks, you could expect a multiplier effect for the clients as well.
All right, Shonali, thanks very much. We'll watch for that interview with John Gray later on today. Of course, Blackstone's John Gray is going to be joining us, President and CEO, joining Shonali, I should say, at 8:30 a.m. in the midst of Bloomberg surveillance. That's an interview you don't want to miss. If you're in London, that's 1:30 p.m. Set your watch. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, let's have a quick look at what is coming up today. At 7:30 a.m. Eastern, the ECB will publish the accounts of its
what a place to sell short euro at 109.63.
From Commerce Bank a little earlier on.
Okay,
an hour
we're
later
quite
than that,
close, so if
we'll
you want
get
to
an
place
update on
order
the US labor
at
market
this
with
level,
the latest
please
initial
do
jobless
so.
claims numbers.
109.
US existing home sales data will be released. 15 minutes later, US Treasury Secretary Janet Yellen will deliver remarks on the US-China economic relationship.
Euro against United States
of
dollar.
interest. And throughout the day, we'll be hearing from a host of Fed officials, including Christopher Waller, Loretta Mester,
and position open.
Others in the mix as well. Plenty of
position
Fed
open, new
and
position
that's because then we go
at
into a quiet period, Matt.
109.63.
So if the Fed has anything
If you want to follow trades, please stay with us, and we'll close this trade together.
Logan, Bowman, Mester, and Waller today.
Yeah, a lot of Fed speak, and likely they're going to be telling us the same story that the market already anticipates. One more hike of 25 basis points on May 1st and then a pause. But of course, we still have a slew of economic data coming in between now and the meeting. I mean, for example, we have the non-farm payrolls number, which used to be referred to as the granddaddy of all economic statistics, coming out right before...
That's when there was no inflation.
Exactly. Right before the meeting. That's exactly before we paid such close attention to the PCE and the CPI and the PPI and everything. But we'll be watching it all, and so will the Fed. So, you know, I think John Maynard Keynes has been horribly overquoted in saying something like, when the facts change, I change my mind. What do you do, sir? Blah, blah, blah. But the Fed obviously is very data dependent.
Absolutely, very data dependent, and we'll also get PMIs from various parts of the world tomorrow. We're throwing into the mix. That is it for early edition. Surveillance is ahead. We'll be hearing, as Matt was saying, from Blackstone President and COO John Gray. He'll be talking to the team 8:30 a.m. Eastern Time. This is Bloomberg.
Specifically?
1953 has a lot of relevance in general. So that's the year where the European countries start opening up their imports to the dollar zone. It's the London debt deal with the Germans after the war around German debt. But it's also one of the years where the Fed is really forced to make a really important decision. So it's where a lot of their desire to get out of the bond market, and I'm sure we'll talk about what they did during the Second World War. It's a very controlled market. It's very heavily managed by the Fed on an active basis. They really pegged yields in the long end, and getting out of that is complicated. And in 53 is when the market really tests them. So we didn't have the "don't fight the Fed" mantra quite yet at that point.
But this is like a really interesting philosophical question right here, because there's always this question today or in any period, to what degree is the rate that we see on a 10-year, on a 30-year, on a 2-year, a policy rate versus a market rate? Before we get to 53 specifically, can you just talk a little bit more about what you said about how rates across the curve were essentially policy rates?
Yeah, when we think about a 10-year rate, like you could do one of two things. You can roll treasury bills every 3 months for 10 years, or you can buy a 10-year bond. So in a perfect world, those two things are connected through expectations.
People are starting to have a little bit of a fear of missing out.
This is really a story of who can maintain profit margins in a declining nominal inflation environment.
The entire banking system is going to see their deposits shrink.
Everybody's anticipating that we're still going to have this tightening of lending conditions, tightening of credit conditions that takes place.
What got us into this issue to begin with was higher rates. The longer you keep them there, it's going to expose other fragilities.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Equity futures negative 0.7% on the S&P 500. This hour, 3 banks reporting. Later today, I've counted 6 different Fed speakers. Bramo's got the job of breaking down who they are and when they speak. But seriously, 6 different Fed speakers throughout the whole of today, going into the quiet period before their next meeting on May 2nd, May 3rd for the Federal Reserve. We need to start with this quote right here, though, from Secretary Yellen of the Treasury on China. On China, and basically stating that security issues, they trump economic concerns. Here's the quote. National security is of paramount importance in our relationship with China. We will not compromise on these concerns, even when they force trade-offs with our economic interests. Lisa, this was a theme from the IMF last week. It's a theme we'll be talking about later today.
It's the quiet part out loud, which is that the number one is national security, and that could mean potentially some implications for businesses that have big China presences and have been expanding there that may not be able to in the same way. How do we price this in at a time when this is looming over, but no one really understands the consequences?
Now, this is a more sophisticated way of describing what the previous administration was doing, wasn't it?
To some degree, although what we have seen consistently is that no administration is willing to go through with the pain required to really cut off ties with China. I mean, that's basically been the read-through again and again. Is this time different? At a time when the national security interest seems like it has changed in terms of the nature of the pressures.
You're going to hear from Secretary Yellen a little bit later on this morning. Lisa will give you the time of that later on in this programme. About 15 minutes from now, we'll catch up with Libby Cantrell of PIMCO on this topic. The broader story for the market looks like this morning. We pulled back on the S&P 500, down around about 0.7% on the S&P. Yields on a 10-year come in about 3 basis points, 356 on 10s this morning. Crude backing away from 80, a little bit more. We're down to 77.71. On WTI, we're down 1.8%, and the euro just in and around 109.50 here, Lisa. Euro dollar 109.64.
As you mentioned, we are getting a bunch of regional banks today, including Truist Financial, Blackstone, which is in a regional bank. That's a big financial firm. KeyCorp, Fifth Third, Huntington Bancshares, Comerica, Citavis, and East West Bancorp. That's all today. Most of those are in this hour, so in a tremendous slew. What have we learned so far? Really, what we have seen is these shares have been pummeled year to date for all the regionals, even the bigger ones like KeyCorp and Fifth Third, down more than 10 to 20% in some cases. But the bigger result is we haven't gotten any big surprises, as you've said multiple times, John. And the KBW Regional Bank Index really hasn't recovered. So are we out of the woods? No. And I think that we heard that yesterday from John Williams, basically saying we don't know. There was a shift. We haven't seen it reflected, and we are watching it closely. As you've said, 10:15 a.m., Treasury Secretary Janet Yellen is giving this speech on U.S.-China economic relations at Johns Hopkins. James Gorman over at Morgan Stanley yesterday talking about the geopolitical risks hanging over their business and how it's just the unknown that they're watching very closely because this could have a real kind of sea change feel to it. And I think that, again, when do we start to see it bear into the earnings as some of these companies with big China presences have to move away at their expense? And today, okay, you asked for the Fed speakers. Let's go there. Fed Governor Christopher Waller, Cleveland Fed President Loretta Mester, Fed Governor Michelle Bowman, Atlanta Fed President Raphael Bostic, and Philadelphia Fed President Patrick Harker, just jamming it all in there before they have to be quiet. I mean, to me, do they want the final word before we exit this quiet period into a quiet period where they're banned from it? Like, what are they going to say?
Did you run out of space on the graphic to put all the Fed speakers on?
And Michael McKee of Bloomberg Economics. I mean,
it's Michael I'm going to want to talk to.
Exactly.
Just to break it down.
Well, what we have heard is a more consistent theme. The fact that John Williams yesterday had the same kind of tone as Goolsbee of Chicago was interesting. They don't know what kind of credit tightening there will be, but they are seeing signs that that is the case. And the Fed Beige Book yesterday really highlighted that there has been a shift downward in growth, a shift downward in inflation, and a real tightening in lending conditions. They want to assess this. Will it keep them from going 25 basis points? Not really, but people are looking at some sort of pause.
To be clear, we don't know either. And at risk of sounding like a financial market therapist, there is a difference between surviving and thriving. We're talking about some of these regional names giving us some indication that they can survive. I don't think we've seen many indications that they can thrive whatsoever.
You saw just pretty consistently losing deposits that don't bear any interest, shifting and having to pay up for deposits. That is one theme after another. Zions Bank yesterday came out. Those shares lower in pre-market earnings today. And basically, they lost 16% of deposits year over year. They are tightening some of their lending with respect to commercial real estate to try to increase some of the standards, exactly what you would expect in response to the current situation.
Joining us now to discuss is Sharon Bell, Senior European Equity Strategist over at Goldman Sachs. Sharon, good morning and wonderful to see you, as always. A little bit later this hour, we'll hear from banks like Fifth Third, Key Corp, Comerica. I won't ask about those single names, Sharon. They don't fall under your coverage. I just want to know from your perspective what you're looking for at the surface level from the regional banking story as it develops still here in America.
I mean, I would imagine the regional banks are still going to be very weak. You've only seen the first hit. You've seen the first sort of stresses come through over the last quarter or so. Obviously, you've seen some of those regional banks fail, and that was the big news. And now you've got the tightening of credit and lending conditions. But we haven't really seen US growth deteriorate that much yet. The first quarter is likely to be reasonable economic growth. We expect US growth through this year, the next few quarters, to be very slow. We're not in the camp of forecasting a recession, but we still believe that US growth will not be far off of zero for the next sequential quarters. And of course, that's going to hit the US regional banks as well. So I don't think completely out of all the problems yet.
Although on a relative basis, has this all been priced in with respect to people flooding into Europe, into European equities, into the euro, into this feeling that anywhere other than U.S. is probably better in a circumstance like this? Have we already played that trade out before it even happened?
I mean, I think, to be fair, the US equity market started this year at a very high valuation. The US equity market started on a high valuation. Europe was on a big discount. That's still the case. There's still a large gap between the two markets. So absolutely, you're right. European equities have outperformed so far this year. But a lot of that was at the beginning of the year when we had sort of gas prices come down a lot, which was an amazing help to Europe. Now I think you've started to see Europe outperform for slightly different reasons. It's the fact that the European economy looks a little bit more resilient, perhaps in the US over the next couple of quarters. So maybe a little bit more to go for Europe, but I agree the pace of performance of actually both the US and European equity markets have been reasonably good this year, particularly given the story on economic growth slowing down and earnings revisions still being quite weak.
One reason behind the strength that some people see in Europe, many people will say, is China and the reopening there. And I'm wondering, as an equity strategist, how do you factor in the words of Janet Yellen in the United States of the bifurcated nature of the European response and the U.S. response to some of these national security threats coming from China at a time when that's the big tailwind right now underpinning European growth?
Yeah, so I think particularly for the luxury goods companies, China has been an enormous factor. But to be fair to the luxury goods companies, they're global. They're not just exposed to China. They're exposed to the US and Europe and generally global travel, and all that's been an incredible support. But I think with respect to the China story, a lot of companies exposed to China obviously are concerned. You have got the recovery trade in China the early part of this year, as you've seen the reopening come through, and some of the data has improved a lot. But I think more medium term, there are concerns about China. There are concerns about the property cycle deleveraging. There are concerns about the aging population and the low population growth. And there are geopolitical concerns that Yellen is talking about. So all of those concerns add up. And if you're very, very dependent on China growth, then I think you're likely to be on a discount.
Well, let's talk about discounted areas elsewhere in the European equity market, Sharon. One feature of that conversation for a long time has been the financials with you. Sharon, the bank's obviously got into difficulty over the last couple of months. Is that a trade you and the team still like? And does the logic still stick for you?
Yeah, that's a great question. I think, and you're right, difficulty absolutely in the last month. And, I think that as we discussed, the US regional banks, if the economy slows, are still going to find that a tricky environment. We like the banks in Europe. And the reason we like the banks in Europe is we are expecting slightly more rate hikes in Europe. In fact, we added new rate hikes, additional rate hikes into our forecast for the Bank of England and the ECB, reflecting the fact that these central banks still have work to do to bring down inflation. And of course, rate hikes are generally good for banks' margins. Economic growth in Europe as well. We're not expecting a recession. We think Europe will narrowly avoid a recession. Again, that's important for the banks too. And then finally, on the European banks, they are extremely cheap with a lot of potential to buy back shares and pay dividends. So for all those reasons, we do still like the banks in Europe.
Sharon, when you say Europe, do you mean Eurozone and not UK? What's the dividing line between the UK banks and the European names?
Yeah, there's a little bit of difference there, but in a way, it's not huge in our view. In both cases, they trade on very similar multiples, provide, in fact, the UK banks generally higher dividend yields than the European banks. So I think the story for UK banks is somewhat similar as well. I'd actually say another thing for both UK and European banks, to the extent that this is a sector which is slightly more domestic than other sectors. So if you're seeing sterling rise and you're seeing the euro rise, not every bank is domestic, but it's more domestic than most sectors in Europe. A lot of sectors in Europe, hugely international. Of course, if currencies rise in Europe, that hits their earnings when they remit those, translate them back into euros or sterling. If you've got domestic sectors at the moment, they would tend to do better with stronger currencies. So I think that also favours the banks on both sides, UK and Europe.
It's a trade you've liked for a while. It's delivered in a big way over the last 9-10 months or so. Sharon, thanks for being with us this morning. Sharon Bow there of Goldman Sachs on the equity market and on the financials as well. We'll turn to the US financials this hour in the 6 a.m. hour here in New York. Fifth Third, Key Corp, Co-America, and a whole bunch more than that. Lisa, we're going to be busy this morning.
And we're getting some initial small bank earnings. We've already gotten Bank of California, and I'm just looking with total deposits, missing estimates. No one really talks about Bank of California in the same kind of tone as Morgan Stanley and Bank of America. However, this matters because A, it's in one of the problem regions, and B, this really confirms this question of how much are deposits moving out of some of the smaller banks. It is still significant. Even if it isn't catastrophic, it's still significant, which goes to your question. Okay, we might not be talking about existential angst, but with our profits.
Surviving, not thriving, is going to be a theme for us this morning, I'm sure. And on Monday, First Republic reporting on Monday. This story will continue through the week and into next week as well. Through today, can we just go through that Fed speak again? Waller, Mester, Bowman, Logan, Bostic, Harker.
Sounds like a song. Sounds like an REM song.
6 Fed speakers. What, in like kindergarten?
Yes.
Something like that.
Waller, Mester.
TK would love that. TK would love that. We missed Tom this morning. Tom, I hope, is going to be back with us tomorrow. Coming up in the next hour, Julian Emmanuel, Chief Equity and Quantitative Strategist over at Evercore ISI, joining us in about 50 minutes from now. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Democrats are rejecting House Speaker Kevin McCarthy's proposal to raise the debt limit for about a year and cut government spending. The plan would increase the debt ceiling by $1.5 trillion. It would also cut discretionary spending by $130 billion. If the debt limit isn't raised, the U.S. would default on payment obligations as soon as June. The U.S. Supreme Court has extended access to a widely used abortion pill until at least Friday. Justices are considering whether to allow restrictions on the drug to take effect. A lower court in Texas has ruled in favor of abortion opponents who want to roll back FDA approval of the pill. Bloomberg's learned that secret recordings by a fired Fox News producer helped push the network to its settlement of a defamation lawsuit by Dominion Voting Systems. Now, Fox lawyers feared that the recordings made by Abby Grossberg and her testimony would be used against Fox chairman Rupert Murdoch and other witnesses. A Fox spokeswoman calls the account of the recordings widely inaccurate. In China, banks kept their benchmark lending rates unchanged today. The country's central bank held back from easing monetary policy this month as the economy rebounds. China's 5-year rate, a reference for mortgages, remains steady at 4.3%. And Tesla will continue to cut prices to spark demand for its electric vehicles. Elon Musk argued that he has good reason for doing so. He said that Tesla can withstand price cuts, giving it the upper hand against rivals. Investors aren't so sure. The shares are lower in pre-market. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
multi-trillion-dollar industry. industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Been to probably 50 of these meetings over the years, and I cannot recall such a division between what the IMF writes about, what they talk about, and then you go out of this building and meet in the private rooms with private investors and other private sector people, and they all talk about Russia, China, and then to Europe, right? Sorry, US, China, and the war, and then Europe. They don't talk about the elephant in the room. Economic policy of 30 years is out the window.
Eric Nielsen of UniCredit was absolutely fantastic at the IMF World Bank spring meetings last week down in Washington, D.C. The takeaway for many of us, we had these conversations both on air and around the building, in the corridors of the IMF. Ultimately, national security concerns Trump economic policy. And you're getting some of that from Secretary Yellen this morning. We've got some prepared remarks. You'll hear from her a little bit later on today. Lisa mentioned a time, 10:15 Eastern time, so a number of hours from now. But here's one of the quotes from what she will say. National security is of paramount importance in our relationship with China. We will not compromise on these concerns, even when they force trade-offs with our economic interests. Now, Lisa, it's a very, very straightforward way of saying what I think we already know already.
Yeah. And trying to rebut some of the responses from China, saying these national security actions are not designed for us to gain a competitive economic advantage or stifle China's economic and technological modernization. But to me, the big question is, how much is this priced into the market? What is the potential implication for businesses that have been expanding in China quite rapidly, including the financial sector, including big tech, at a time when this fissure is only going to widen?
Well, let's talk about the dividing line between rhetoric and policy. In the previous administration, we got a ton of rhetoric, but we got policy too. The trade war started between China and the United States under President Trump. A lot of rhetoric here. What about the policy? What kind of shift are you actually expecting off the back of this kind of language?
Well, we've already heard the proposals to ban TikTok. We've already heard the proposals to potentially eliminate some of the exports of chip technology, which perhaps wasn't as significant as some people thought based on the earnings of some companies that have been coming out. But nonetheless, there have been some tangible actions that have pushed the likes of Apple to very quietly shift away production from China. Again, we don't know the scope of this because no company is going to come out and say that they're doing it until they're already done.
Ambassador Tim Cook just kind of making the moves
exactly
behind the scenes. Libby Cantrell joins us now, Head of Public Policy over at PIMCO. Libby, I've been looking forward to this conversation. Thanks for being with us this morning. Can we start there? I think it's a really, really important topic for us today and maybe over the next decade, Libby. What kind of actions are you expecting from this administration off the back of comments like these?
Yeah, well, John, your earlier comments, I think, are spot on. The rhetoric of the previous administration was quite strong. We saw that somewhat followed up by policy. But this administration, actually, the rhetoric has been maybe a little bit softer. They've really emphasized, strategic competition, but also cooperation. Cooperation follows sort of closely after that emphasis on competition. But I would argue that the policies have actually been more substantive from the Biden administration and more punitive in many ways as it relates to China. So as Lisa mentioned, we saw those export controls on semiconductors. We think that's the beginning of a broader process around export controls. But importantly, John, this should be forthcoming in the next few weeks, months, but definitely by kind of midsummer, is this executive order on capital outflows that would require at least disclosure, if not prohibition, of some capital outflows from the United States to China in specific sectors for sure, but it could have spillover effects to the public markets as a sort of this chill in general goes on in terms of investment from the U.S. to China.
Libby, how many of the investors you speak with fully appreciate what the implications of this are from a pricing perspective, from a demand perspective, and just in general, from reshaping the way that markets really trade?
I think a lot of our clients realize that the political risk of investing in China is increased, and maybe the economic benefit of investing in China is also not as much of a sort of as clear cut as it was at least several years ago. So we are sort of seeing a reticence, especially in our U.S. clients, more of a kind of a tilt toward a home bias. Still an appreciation for diversification, still understanding that China is going to be a source of global growth over the secular and super secular time frame, but also just sort of realizing that that some of these investments may be fraught and again maybe tied up in both the political rhetoric, but also some of these policies coming out of Washington.
It's one thing to avoid buying Chinese bonds or stocks. It's another thing to question the valuations of, say, an Apple or some of the other technology giants at a time when so much of their businesses really rely on China. Not just them, frankly, auto manufacturers, fast food companies. There's so many basic corporate America standbys that are tied to China growth. How much is that appreciated?
Yeah, again, I mean, I think that it's not to say that the domestic market in China is not going to continue to grow, and I think some of those companies are aimed more at that domestic market. But just in general, being a U.S. investor, and of course that's who we're talking to in terms of our U.S.-based clients, and they do sort of see that this is more fraught in terms of actually investing U.S. dollars into Chinese companies. It's not to say that this is not going to, this is going to stop altogether, but I think this administration is sending a pretty clear signal that they are going to at least require some disclosure and some oversight into how kind of U.S. dollars are being allocated in China, and importantly, are they going to sectors that could increase sort of the military and competitive might of China.
Libby, this is the United States looking out to the rest of the world. Let's talk about the rest of the world looking into the United States. A big topic of conversation, as you know, later this summer is going to be the debt ceiling. We've had tax day. I think a lot of people are trying to use that to try and understand where that X date might fall. Libby, have you got a deeper understanding, a better understanding of where that date might be?
Well, I think we're beholden to the data just as anybody else is. I mean, there was some promising data that came out yesterday, just in terms of potentially getting past this June 15th tax filing date. I think that's been the open question. Is there sort of enough capacity for the Treasury to get to this, to sort of beyond this June 15th date, meaning that then they have more extraordinary measures to deploy, and then likely the X date will fall sort of mid-July, end of July, maybe even August or even early September. I think there was some question around that and some concern that actually they may not get past that June 15th date. I think yesterday, John, what we saw in terms of the Treasury data and the receipts is that we may actually be able to get past that June 15th date, meaning the X date is pushed more to later in the summer. And I think actually there's some folks in Congress, though, that wouldn't mind the X date being closer, more right around the corner, just because then that sort of forces folks to actually come to the table and to seek a resolution.
Speaker McCarthy says he's got a plan. Do you think there's a plan out there at the moment that you see as realistic?
Well, he does have a plan, and he's now there's a bill, actually. So it was a plan on Monday when he was up here in New York. Now that it's actually in legislative text, I think, John, the real open question is, can he get 218 members? Of course, Republicans are only 222 in the House of Representatives. That means he can only lose 4 in order to actually get this through the House. Now, investors in the market should realize that whatever is passed, if this bill gets passed, it will not be signed into law. This is, of course, dead on arrival in the Senate, but it's important from a Speaker McCarthy perspective because it would increase his leverage with the White House. Right now, all he does has legislative text, and he doesn't necessarily have a bill that's been able to pass the House. And I think that's the open question, John. If he is able to pass this, again, this will not get signed into law, but then at least it sort of starts formally these negotiations and certainly increases his positioning and negotiating power with the president.
Libby, you're one of the very best. We're lucky to catch up with you again. Libby Cantrell there of PIMCO. Let's do this again soon on this topic. Lisa, it's a frustrating topic for so many people on Wall Street. Still, I have the conversations with people, you have the same conversations, and they just turn around and go, don't want to talk about it yet. We'll talk about that in a few months.
Basically, the implications could be pretty significant if the U.S. does default. But then the U.S. never defaults, and they always kind of come to some sort of last-minute resolution. As we just heard from Libby there, some people actually wish that this were sooner, so it wasn't just hanging out there, and we know just how close to the X date we're actually going to get. That said, this time does feel more fraught because it's been made an actual election issue to not raise the budget on the side of certain Republicans. So that makes it a little bit more difficult to really pass something through.
It's incredibly frustrating for so many people. So this is spending that they've already agreed to spend, and ultimately there's this battle because there is another topic that they want to discuss, which is debt sustainability, and then they merge the two issues together because this is the perfect time to have the conversation, right?
You raised a really good point. What does this do internationally? As people look to the U.S., it's like, really? You guys doing this again?
I know.
What does this mean? Like, why do we have to deal with this?
Well, the U.S. has the luxury of not having an emerging market debt market, so we treat treasuries a little bit differently.
You mean basically pile in?
You can act a little bit differently as a politician here without the same blowback in the market. Let's put it that way.
Very delicate.
For now. Futures on the S&P negative. This is Bloomberg.